Okay. Good morning, everyone. Welcome to the second session on Ind AS 113. So, in yesterday's session, we had started to discuss on the definition of fair value. So, to put it in a nutshell, the fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So now what does this mean? Well, this means that it is first of all an exit price. So when I say exit price, what do I mean by exit price? The price that the entity would receive to sell an asset. So your estimation of fair value would be on the basis that you would be parting with this asset. So that is the assumption that we are going to have when I'm doing the fair value estimation, or the price paid to transfer the liability. Now, when I say transfer the liability, it means that the intention is not to settle the liability, the intention is to merely transfer it. For example, as I discussed yesterday, I have issued debentures and somebody else wants some funds. So they come to me and then I say, look, I have these debentures, they will become due for payment after a couple of years. So I will transfer these debentures to you, and along with the debentures, I'm going to transfer the money for that. Now, on the date of settlement, the debenture holders will not come to me for the redemption. They will go to the counterparty to whom I have transferred the debentures for the settlement. So this is how the transfer of a liability works. So the amount I pay to transfer that liability. So I'm again parting away with that liability. I'm putting that liability on somebody else's head. So therefore, that also is a exit price. So we are essentially concerned with the exit price computations when I'm doing my fair value. And this fair value is considered based on an orderly transaction between market participants. So market participants essentially would mean those people who are not related to the entity, or those persons who are not related to the entity. Because generally when I talk about market participants, my pricing is going to be absolutely fair. Although the standard has given a small consideration by saying that if I have transactions with related parties and they are at arm's length, they could also be considered at fair value. Then the next one that we are having is appropriate market. So the transaction should happen in what is known as an appropriate market. So in respect of appropriate market, we saw two types of markets. The first one was the principal market. So the principal market is essentially that market where you have the highest number of buyers, highest number of sellers, and you have maximum number of transactions in such a way that no single buyer or seller or a group of buyers or sellers can influence the price. So when you have these kind of setups, the buyer is aware of the pricing, the seller is also aware at what price can he do the sale. So everybody has knowledge of the transaction. You cannot end up in colloquial terms fooling anybody else. You cannot bluff anybody else. The price will ultimately tend to the fair value, which is what we see on what you can say on perfect markets like the National Stock Exchange, where generally the prices tend to the fair value. Okay, so that is your principal market. The definition is close to the perfect competition that you had studied in your economics. Okay, so if for the product whose fair value you are determining, if it has a principal market, then the fair value will be taken based on the pricing in the principal market, subject to the transportation cost adjustments. Okay, so we'll come to that in a short while. But if there is no principal market, then there is something known as the most advantageous market. See, when we talk about Ind AS, the first thing we have to remember is we are not anymore going to be discussing about prudence as a concept. So the fundamental presumption behind Ind AS 113 is that you are definitely going to sell your goods in the most advantageous market, because that is where the entity stands to benefit. Ideally, preference will go to the principal market because that is the fair value from the perspective of the commodity, you are fair value. But if a principal market is not determinable, then what you are going to do is you will obviously sell the goods in a place where you think will be most advantageous. What do you mean by most advantageous? Sir, most advantageous means when I sell the product, the net proceeds that accrue to me should be maximized. We are no longer in the AS regime, which would require us to say, why do you think maximized? You can consider the minimum one because of prudence. No, that is not acceptable here. We are in a realistic situation. We presume that we are a business entity and therefore we have a rational sense of transactions. And therefore, I am going to sell my goods in a place where my net proceeds are going to get maximized. And that is why if the principal market is not available, the second market which you are going to have a look at is the most advantageous market. The most advantageous market maximizes the net proceeds for me, and the net proceeds is nothing but the available price minus the transportation cost minus the transaction cost. So when I say transportation cost, normally for goods it will mean the price, the cost to enter that particular market. So you are changing the feature of the asset. Sir, which feature? The location of the asset. It is a feature of the asset. So you are changing the location and ultimately the characteristic of that asset. And when I started the discussion, I said that fair value considers asset liability specific conditions, restriction, advantages, disadvantages. But it does not consider entity specific restrictions, advantages or disadvantages. So this was made pretty clear in the beginning of yesterday's session. So therefore, transportation cost alters the characteristic of the asset. For goods, they could be actual location, but for certain cases, it could be cost like cost of completion of the asset. So cost of completion also alters the nature of the asset and therefore you can arrive at the fair value after deducting the cost of completion. So when I say transportation cost, I basically mean those costs which alter the nature of the asset to make it in some way ready for sale. Okay, in a very layman's language, to make it ready for sale. So these are those costs. And we also deduct the transaction cost. What do you mean by transaction cost? Transaction cost could be brokerage, commission, etc., which are identifiable to the transaction, but they are not identifiable to the asset or liability whose fair value we are determining. So therefore, see, after deducting the transport and transaction cost, we are left with what is known as the net proceeds. This should be maximized. But when I do the fair valuation, I will not consider the transaction cost because transaction costs are not asset specific or liability specific. They are transaction specific. Brokerage that you pay is pertaining to a transaction. It's not pertaining to assets or liabilities. And therefore, in the absence of a principal market, when we look at the most advantageous market, we do not consider the transaction cost for arriving at the fair value. Rather, we only consider the available price minus the transportation costs for the purposes of determination of fair value. So ultimately, when we ended yesterday's session, we ended it based on the understanding that fair value is price minus the transportation cost. And in our example that we did yesterday, the most advantageous market was the export market because it maximized by net proceeds. And therefore, the fair value would be 1500 minus 700, that is 800 rupees. Though it appears that the fair value of the local market is higher and we should take that, our presumption is the net proceeds are high. This commodity does not have a principal market. So on the basis of the most advantageous market, the export market would become most advantageous and therefore the fair value would come from that particular market. And therefore the fair value would be 800 rupees. Are we clear till now? Anybody has any doubts, any issues, any Any problem or any clarification needed in this regard? Good morning, Shailesh. Good morning, Viraj. Good morning, Namrata. Yes. What do you guys think? Anybody has any doubts? Please feel free to ask, because then I will be proceeding further. Okay. Where are the others? Others are not there. Tanisha is there. Vanshika should be there. Then I should have Yadu. Okay, Shruti. Okay. Sir, a small doubt. In the non-applicability disclosure clause, why only plan asset and recoverable amount is there? Whereas other Ind AS, which has a fair value concept, should also be included in the non-applicability clause. No. What happens is, see, when I talk about, so she is asking from the presentation that in the non-applicability scenario, yes, the scope, objective and scope, Shruti is asking, why do we have only plan assets and recoverable amount disclosures for the disclosure applicability, for non-applicability of disclosures? Well, what happens is plan assets are a very special category of assets. They are there exclusively to meet the obligations due to the employees. It could be obligations of gratuity, obligations of leave encashment, obligations of long-term payment, retention bonus, whatever it is. And therefore, these particular obligations are satisfied out of these plan assets. So therefore, the disclosure of the plan assets is not a simple disclosure where you just show in the balance sheet that it is a plan asset. We are netting the plan assets against the obligations due to the employees, and we are presenting it as a net defined benefit obligation or a net defined benefit asset. If the assets are higher, if obligations are higher, it will be a net defined benefit obligation. This netting off is under the guidance of Ind AS 19, which we will be studying in the coming weeks. So therefore, when this particular setting off is prescribed under Ind AS 19, I cannot have the disclosures of Ind AS 113 coming into Ind AS 19, because Ind AS 113 talks about disclosure of plan assets as a whole. Right? So 113 does the valuation for the plan assets, but the disclosure is netting off against the obligations, which is the feature of Ind AS 19, and that is why it is excluded here. Similarly, the recoverable amount disclosures for Ind AS 36 is specifically governed by that particular standard, because we are not focusing on recoverable amount, but what we are focusing on is the impairment that is required to arrive at the recoverable amount if carrying amount is greater than the recoverable amount. So all these disclosures form a part of that specialized standard of Ind AS 36. 113 is giving only the measurement inputs. Is giving only the measurement inputs for fair value less cost to less cost of disposal, and therefore I value that. But the disclosure pertaining to recoverable amounts, we will refer Ind AS 36. In all other standards, netting off is a rare scenario. You will only see it in 109. In all other standards like property, plant, equipment, investment property, etc., there is no concept of netting off. So therefore, you do the fair valuation, and the disclosures pertaining to that fair value will come in line with Ind AS 113. Okay. So in these two cases, you have specialized presentations, and because of the specialized presentation, the disclosure requirements are governed under those standards only. Okay, so that takes care of her query. I hope you have understood. Okay, so with this, we are done with what is fair value. Orderly transaction, everybody is aware of the particular market, the product. There is no ignorance on that regard. So that is an orderly transaction. No distress, no stress, no distress sale, none of that conditions are there. It is a plain all conditions satisfied, same. No coercion, no misrepresentation, no willful misrepresentation, nothing of that sort. So that is an orderly transaction in a transaction between market participants in the most appropriate market. So we have discussed all these particular what you can say legs of the fair value definition. Now we come to certain special cases. We are having a couple of special scenarios, and once we complete that, we are done with the standard. Okay. Now I discussed about fair valuation. I discussed about fair value. And when I discussed fair value, I gave you typically the example of land. I told you the land is situated and you have the permission to construct a residential complex, a commercial complex, etc. So land is a non-financial asset. Land is a non-financial asset. Whereas we also do fair valuation of equity instruments and other financial assets, equity and other financial assets in general, even financial liabilities. Now, these are my financial assets or liabilities. Now, the question is, see, when I talk about financial assets, my usage of those assets is very clear. There is no ambiguity about it. When you invest your money in shares of Reliance or in shares of Tata or in shares of Larsen and Toubro, what are you expecting? What are you expecting? Give me your answers. When you are making investment in equity shares, what are your expectations? What is your probable expectation? Yes, yes. Good morning, Yukta, Geeta, Muhammad, Manoj. Yes, good morning. So when you make investment in bonds or shares or debentures, what are your expectations? Your expectations will be one is capital appreciation. That means you expect that the market value of the shares will appreciate on account of performance, and therefore you stand to benefit from that. So one is the appreciation in the value of the asset, and the second one is dividends. So basically, my returns are categorized into two things. One is capital appreciation, the other is dividends. It's only these two things and nothing else. And therefore, when I talk about financial assets, when I talk about the financial assets, my incoming returns or the returns on these assets are pretty much standardized. They are pretty much, what you can say, unambiguous, not having multiple options. They are pretty much straightforward. You don't have to do a lot of thinking. You cannot do anything else with a financial asset. So that is the biggest advantage of financial asset when it comes to fair valuation. There is no other use possible from the financial asset. कुछ और नहीं कर सकते आप. You have only two things. Hold the asset, enjoy the returns, get the dividends, stay back. Second option, you want to sell it off, you are going to get the money. If it is bonds, yes, you are going to get the interest thereof. तो यही तीन चीजें हो सकती है. Nothing else is there. Life for investors of financial asset, as far as returns, is pretty much straightforward. However, when it comes to non-financial assets, let us take yesterday's example, land. When it comes to non-financial asset, the uses are multiple. The uses are multiple. I have a plot of land. What can I do? Well, on the plot of land, I can convert it into a parking space and collect the toll. I can construct a commercial complex. I can construct a residential complex. I can construct a resort or a hotel. I can, what you can say, I can construct a mall or a shopping complex. Okay. I can leave it vacant. वो भी तो एक option है. I can leave it vacant. I can use it as what you can say. I can rent it out. Rent out. I can do that. Rent out for exhibitions, etc. Yes, rent out for exhibitions, etc. I can alternatively use it as a dumping ground. Yes, I can tell people this is my land. I have a lot of money, so I will give this as a dumping ground. You can dump your garbage in this. So you can use anything and everything this land parcel. Okay, anything. You can construct your own house. Yes, anything is possible. Absolutely anything is possible with this land. Now, you tell me one thing. Is if I use land as a parking space, if I use this land for a commercial complex, okay, let me give you extreme examples. Okay, let me ask your opinion on extreme examples. Commercial complex. I built a commercial complex on this land. Yeah, agricultural purpose. This is another one. I can use it as a dumping ground. Now I want your opinion. The value of the land, if it has a commercial complex on it, and the value of land, which is a dumping ground, do you think the fair value of both of them, is it going to be the same or is it going to be different? Okay. Is it going to be the same or is it going to be different? The land is the same, but in one case, I have the option of constructing a commercial complex. The other option I'm having is to use it as a dumping ground. So in both the cases, do you think fair value of that land will be the same? Or do you think the fair value of that land is going to be different? What do you guys think? It will be different. Yes, Muhammad, Kirti, Namrata, everybody gave the right answer. It is going to be different. Okay. So now my question is, does it imply that for each of these uses, the fair value will be same or will it be different? I have about 7 to 8 uses. If you think a little more, you will have another 100 uses of this land. If it is a huge complex, I can build a helipad on that. I can have my own private airport. I can, use it for farming. I can construct something like AdLabs, Imagica. I can construct a theme park on this. Thousands of uses are there. But my question is it going to be the same fair value for each use or is it going to be different? And the answer is it is going to be different for each use. A person who constructs a park, an amusement park on the land, the value of that is going to be very much different if it had to be a commercial complex or if it had to be a residential complex. So now the point is, sir, you are talking about asset specific values. You are talking about asset specific values. And when you talk about asset specific values, सर बात तो है कि these asset specific values should consider the conditions of the asset. But सर यहाँ पे तो land एक ही है, we are having multiple uses, तो कौन सा value है? We are having multiple uses, multiple fair values. Which use and which valuations should I consider? So therefore, Ind AS 113 again focuses on realistic presentations, realistic value determinations, and Ind AS 113 tells us that you are going to determine only one use, and that is the highest and best use of the non-financial asset. The highest and best use of the non-financial asset. And that particular usage is going to be the basis for determining your fair value, is going to be the basis for determining your fair value. So let us assume this land parcel, you have done all the estimations of all the methods, of all the possible usage of this land, and you come to the you come to the conclusion that yes, the highest and best use is as a commercial complex. If that is the case, the fair value of this land will be the value if a commercial complex were to be constructed on the same. If a commercial complex were to be constructed on the same. Are we clear about this so far? Yes, are we clear so far? Yes, clear. Okay. But now there is a practical problem which Namrata has rightly asked and which I would be addressing. Now the issue is, sir, ऐसे तो कितने options है? There could be some options which never even came to our knowledge. For example, I'm just doing a wild thinking. I can use my land, which is a huge land, into a launch pad for space satellites. Okay. I will tell the government, look, this is a parcel of land. I will do the facility of constructing a launch pad. So whenever you have to send something like a Chandrayaan or Gaganyaan in the future, you can use this land. Whoever thought of this, there are infinite usage possibilities on non for non-financial assets. बहुत कुछ कर सकते हो आप. You can do anything and everything. And therefore, that is a practical difficulty which borders on impossibility to really estimate what is the highest and best use. And therefore, the standard comes out with three particular conditions which it has mentioned and one rebuttable presumption that is there. The three particular conditions that the standard has laid down is it should be legally permissible. It should be legally permissible. It should be financially feasible, and it should be physically possible. These are the three conditions that need to be fulfilled to say that a particular use can be envisaged for a non-financial asset. Let us assume you have a plot of land of 1000 square meters. Let us assume you have a plot of land of 1000 square meters. For obvious reasons, you cannot construct an airport or a launch pad for satellites into space. बहुत छोटा है, कुछ नहीं जाएगा. Okay, at the most you can fly some paper rocket out of that, but beyond that nothing can go. So it is not physically possible to construct an airport or a helipad or anything remote to a space launch station. नहीं होगा यहाँ पे. So those possibilities are eliminated. Similarly, on a 1000 square meter plot of land, can you rent it out for exhibition? Sir, it is in a residential complex. It is in a residential area. So obviously, you cannot rent it out. You may not get the permissions. You could give it as a parking space. Yes. So you will have to check for these items. Okay. If all the three conditions should be fulfilled. Is it legally permissible? On this 1000 square meters, do you want to construct a resort or a hotel? You have to check whether you get the permissions for that. If your area is close to the coast, then the coastal zoning authority may say we are not going to allow construction of resorts because it damages the ecosystem. And therefore, it is not legally permissible. Some cases in a residential area, the municipality may say we cannot allow construction of a commercial complex because we have these zonings which are there, and under the zonings, this zone does not fall in the commercial complex. So legally, it is not permissible. Financially, it should not, it may be impossible, and physically and financially, It is possible the entity does not have the funds to effect that particular. It is possible that it may not have the funds to effect that particular. What you can say, that particular use. For example, constructing a space station requires thousands of crores. A space launch pad, thousands of crores. हो सकता है I do not have that money. So though it is legally permissible because it is a vast tract of acres together of land, nothing is there surrounding. You can freely construct. You can take the permission of ISRO and government and all the authorities and give that, lease it out to ISRO for the space launch pad. But you may not have the funds to construct the launch pad, and therefore that option does not exist for you. So therefore, all these three conditions have to be met. All these three conditions have to be met. So though there are multiple uses, when I actually start nipping out everything, I will be left with hardly a couple of uses which are possible. And finally, you will consider only those options which a market participant will reasonably exercise, Take, for example, an area like I'm not sure if you guys are staying in Mumbai. Take an area like Nariman Point, for example, or if you are in Mumbai, you can. If you are in Delhi, you can take something like the IT hub of Gurgaon, or you can take the crowded streets of Connaught Place, or if you are in Bangalore, you can take some hip hop place like MG Road or something. If you have a plot of land here, do you think it is possible to, will you want to construct an amusement park in this? Will you want to construct an amusement park in these locations? Nariman Point, hubs of offices. Bandra Kurla complex, if you have a land, it is hub of office spaces. Why will you construct an amusement park right in the middle of commercial complex? It is not a reasonable option. So you will not exercise that. So reasonably certain means you will exercise an option depending on what all possibilities seem reasonable to you. When I say physically possible means the structure of that land should make it possible for you to exercise that option. Sometimes, like you purchase land, see, you have all these celebrities and all who purchase huge properties in places like Alibag and all. Okay. So in Alibag, etc., what happens is they purchase this as a farmhouse. They purchase this for the purposes of constructing a farmhouse. What do you mean by farmhouse? Well, there is one farm, and on that farm you have a house and nothing else is permitted to be constructed. So is it physically possible for you to construct? Answer is no, because it is a farmland. Similarly, if the land is close to the sea, can you construct a high-rise apartment? Nahi ho sakta, because the foundation does not permit it, because the foundation is weak. You cannot construct a 44-towered structure on a plot of land that is just adjacent to the sea. You should not be constructing. Ideally, you should not be constructing because it is not physically possible. Physically possible means whether the situation of that particular asset permits you to exercise that option. For example, I come to another example. You have a plot of land close to the sea and you say, I will construct a hospital on this. How can you construct a hospital close to the sea? Tomorrow something will happen. You have huge rains. You have something like a cyclone that comes in. Do you really want to construct a hospital close to the sea? It's not physically possible. You have a plot of land that is close to the sea, and you say, I will construct a railway station here. How is it possible? It's not possible. So the conditions of that particular asset do not permit you to exercise a particular option. That is the meaning of physically possible. Okay? Or physically impossible. So all these conditions have to be met. So what you are going to do is you will check this and then you will eliminate the options. And once you eliminate the options, you will arrive at only a few cases where you can actually do that particular activity. And out of those few cases, like for example, I will not use it as a dumping ground because government has prohibited. Renting out is not possible because the area is not so huge for an exhibition renting. Malls or shopping complex or commercial complex mean one and the same. Resort or hotel, I'll not get the permission because there are already multiple hotels in that area. Parking space, commercial complex, all these are possible or leaving it vacant. Now the question is, from these cases, what are you going to do? So, sir, the highest and best use requires you to estimate that, sir, kaun sa method, which gives you the highest value. Sir, commercial complex. If yes, that is the use which you can do. Remember, you may not be capable of constructing a commercial complex, but that is entity specific restriction. That is not asset specific restriction. So though you do not have the expertise or though you do not have the chance of constructing, you will still continue to regard this land as suitable for commercial complex, and basis that usage, you will do the fair valuation. You will do the fair valuation. The standard finally leaves you with a very clear guidance. It leaves you with a very, very clear guidance. And it tells that in absence of information, in absence of anything to the contrary, it is presumed that the current use of land is the highest and best use of that tract of land. Or in other words, the current usage by the entity of a non-financial asset is deemed to be the highest and best use. Full stop. That means, do you have to go estimating all the things? Answer is no. You have this rebuttable presumption that is there that yes, the existing usage is the highest and best possible use. And therefore, if you are using it as a residential complex, the standard says that it is deemed to be the highest and best use as a residential complex. So you take the valuation as a residential complex. So you are able to appreciate the standard comes out with a huge set of ideas. It rationalizes those ideas into lower condition, lower number of options by giving those three conditions: physically possible, financially feasible, and legally permissible. And it further narrows it down by saying that in absence of information, typically it is assumed that the current use is the highest and best possible use. Highest and best possible use. So now, as auditors, when you are going to do the audit, will you evaluate all these possible uses of the land that the entity is owning? Answer is it's not required. It is not required because there is this statement that is there that if it is going to be deemed that the existing usage by the entity is the highest and best use. Sir, why do you think it like that? Sir, vacant hai to highest and best. Why do you think so? I think so because it is a rational entity. The management has sound business sense. And if the management has decided for a particular course of action, the management will want to maximize the profits from that. The management will want to maximize the profits from that, and therefore, the management is going to follow that particular method. And I, as an auditor, will not question the management's judgment on the usage of its assets. I can question on other aspects, but I cannot go to the management and say, why did you keep this land vacant? Don't you know you can use it for commercial purposes? Do you think this is the part of my scope as an auditor? No, it's not. You are not here to question the business decisions of the management. That is the job that the internal teams should do. But you, as the auditor, if he has kept the land vacant, probably that is the highest and best use. And therefore, the valuation of that land will be on the presumption that the land remains vacant, you carry out the valuation. You carry out the valuation. So therefore, to put it in a nutshell, the financial capability of an asset determining the highest and best use. There is no standard rule to that. I told you at the beginning, the standard Ind AS 113 does not give you an output fair value. It gives you a set of principles. And the principles are very logical. It's not an illogical assumption to assume that current use is the highest and best use. When you go to buy a car, for example, why do you buy a car? Sir, car के साथ तो हम कुछ भी कर सकते हैं. We can use it for ourselves. We can give it to a driver to use it as Ola or Uber or whatever is there. We can put it on an exhibition. वो भी कर सकते हैं. We can break down that car and sell it off as scrap. We can, use it as rent a car service. Anything and everything is possible with that car. But why do you buy a car? Sir, I bought the car for my own use because I believe that it is going to save my transportation cost. Fair enough. I respect your judgment. I respect the use for the car that made you to buy it. And for my fair valuation, I will arrive at the fair value based on your usage requirement only. I don't have to check rent a car hota to kitna hota, cab or taxi hota to kitna hota. I'm not concerned with that. I'm concerned with the fact that you thought own usage maximizes the value of the car. And because of that, you are using it. I respect that. I will do the valuation of the car based on the fact that own usage is the highest and best use. Okay. Company's intention is to keep it vacant, but you can also use it for commercial premises, commercial purpose. Then what will be the highest and best use? Again, I'm saying respect the company's decision, but it is a rebuttable presumption. What do you mean by rebuttable presumption? As an auditor, you can challenge it. Let me take you one step further. Okay. You have a plot of land. Land is there in BKC. BKC is the hub of everything now. Okay. Bombay mein BKC is the heart of Bombay. So you have offices, you have retail spaces, malls, then that Geo Convention Center is there. Reliance to pura township bas gaya usme, right? So therefore, BKC is the hub. And now you have, you are owning a land in BKC. You have kept it vacant. Now, because it is vacant, you are doing the valuation of that land. And then the fair value comes to the cost in the financial statements is what is disclosed and presented to you. Now, you as the auditor can definitely question that because you see the surroundings and ask him, why did you do the fair valuation based on it vacant? You can construct anything and everything on this. You call a developer and both of you profit out of it. You can do that. You can respect it for whatever they're doing, but when it is plain obvious that an option exists, which could be the highest and best possible use, and that is not considered in fair valuation, you do have an option to question. You do have an option to question. Yes, and you have to. So the presumption that the current use is the highest and best use is not sacrosanct. It is a rebuttable presumption. आप उस पे सवाल उठा सकते हो. You can raise questions if you believe that the current use is not the highest and best use. And accordingly, you can ask them to do the fair valuation. Anything and everything is possible. Anything and everything is possible. So when I say Ind AS, and keep it in mind for all Ind AS, ये rules नहीं है. This is not a rule. I told you multiple use. Then those three conditions. And then I narrowed it down to current use. Yes, this is like a reverse pyramid. मेरे पास options बहुत है. They went on narrowing down, and ultimately came to the conclusion that current use is the highest and best use. But ये ऐसा ही होना है, is it a requirement? Answer is no. It is a principle. These are principles. Okay. Now these principles you will have to apply in the spirit of the standard. So if you feel current use is not the highest and best use, please tell the management, sir, you can construct commercial complex here. Go ahead and do the valuation. Why are you doing the valuation on the vacant land? उससे कुछ मिलेगा नहीं आपको. You are not going to get anything. And therefore, this is how the thought process works for Ind AS interpretations. Are we clear with this? Yes, are we clear with this? Anybody has any doubts? Highest and best use. Anybody has any doubts? Yes. Clear. Okay. Namrata, are you clear? Yes. Okay. Okay, fine. I'm having a new face today, Kirti Salgaonkar. Okay. All right. Salgaonkar is a Goan surname. Interesting. Okay, fine. So with that, let us proceed further. Now, let me just take you to another. Okay, I will rush you through this situations and then move further. Okay. Now, when I talk about valuation of non-financial assets, we spoke about highest and best use. The highest and best use of a non-financial asset, I told these three conditions. Okay. Physically possible, legally permissible, and financially feasible. Fine. Highest and best use is determined from the market participant perspective. I told that also. It does not matter whether the entity intends to use the asset differently. I gave you this. To find out the best possible use, one has to identify the market participants and then to find the best legitimate use of this non-financial asset, which one would normally do. I told you that. Yes. All restrictions specific to market participants would not be considered. That is obvious. In absence of potentially best use, which is not easily available, the plot of land, commercial, residential, shop, resort, amusement park, space launch pad, airport, helipad, whatever it is, not easily available. Then what is your assumption? Current use would be considered the best use. And finally, while considering, this is what is more important. This is what is more important. While considering fair value under any alternative use, deduct the estimated cost to be incurred in order to make the asset ready for the alternative use. So what does it mean? So let us assume that you have these, what you can say, there could be a case where you have these mill properties in Mumbai. Okay, these mills which are there from the past era. Okay, there are still some mill properties which are there, and these mill properties do not have any occupier, they do not have any activity happening, they do not have any use currently. So if I have to do the valuation, now these mill properties adjacent to that, you have high tower residential complexes, 40 story, 50 story. If you go to Lower Parel and that area, you have these mill properties, mill factories. They were all remnants of the past. Okay. Now it is owned by somebody. They are not Benami properties, but they are no longer in use. तो वहां पे क्या है, you are having old mills, rusted factory sheds, rusted equipment. You are having some old buildings which is half broken. मतलब उसका basically it is ruins, खंडहर है वो. It is basically ruins. Okay. Now, if I have to do the fair valuation of that area of that particular mill property that the entity is owning, obviously, the current use is not the highest and best use, because in the vicinity, you have stories and stories of residential properties which are sold at very high prices. So you will be telling, sir, current use to highest and best nahi hai. The current use is to give it for construction of a residential complex. अगर हम वैसा करेंगे, then you are going to arrive at a particular value. Let us say 100 crores. Let us say 100 crores. But 100 crores value तो दिया सर आपने land का, but can I just come to the land and do the construction? अरे no, you will have to first remove those ruins. वो खंडहर साफ करना पड़ेगा आपको. You will have to clean up that space. Let us suppose the cost to clean up that space comes to 1 crore. So this becomes 99 crore. This is nothing but available price, and this is nothing but the transportation cost which we had discussed. This is the cost now to make the asset ready for construction of a residential complex. And therefore, this 1 crore will be deducted. This 1 crore will be deducted because it is an asset specific characteristic. It is altering the asset specific characteristic. Are we clear with this? So this is the meaning of that. While considering fair value under any alternative use, deduct the estimated cost to be incurred in order to make the asset ready for alternative use. Ready for alternative use. Are we clear with this? Yes. Any doubts? Namrata, Muhammad, Kirti, Viraj, Shruti, Shailesh, Yadu, Yukta, are we clear with this? Yes. Geeta, all clear? I hope it should be clear. Okay. All right, fine. Oh, we have some questions. I will come to that shortly. Okay, I'll come to that shortly. I leave this for homework. These are just examples that you can read based on the concept we have discussed. Okay, these are just small homework questions. Please do it up. This also you can do it up. Khali examples hai. This question you can do it up because it is based on a similar concept. Yes. Next one. This also you can do it for homework. There are no figures. It's just theory. Highest and best use you are able to understand from the question. So therefore, you just have to put in your answer. Okay. So that concludes valuations of non-financial assets, valuation of non-financial assets. Mein, what is the fundamental that we are going to do is we are going to use the highest and best use capability of that particular asset. Financial asset, pretty simple. You don't have the concept of highest and best use. वहां पे there is only one stream of cash flows, that is it could be either the dividend stream or interest stream coupled with capital appreciation. So we cannot use this concept for financial asset. Are we clear so far? Yes. Okay. So do you want more theory, or we do two small questions on fair valuation and then come back to the theory? What do you guys think? Hmm? Do you want two small questions and coming back to the theory, or do we continue the theory and do all questions together? We'll do some questions. Okay, fine. So let us do the questions in that case. Okay. I want you to read this question. You will first try this question by yourself right now. We'll do two questions on fair valuation so that we apply the knowledge, whatever we have learned till now. And then we shall continue our discussion. Isha Limited operates in the agricultural sector, and apart from farming activities, it also has a division retailing agricultural activities. Okay. So there is a farming activity and there is a sale of agricultural vehicles. It is currently evaluating a proposal involving sale of the retail division and accordingly wishes to fair value the inventory of vehicles for the purpose of sale. Three markets currently exist for the agricultural vehicles within which Isha has transacted regularly. Isha wishes to determine the fair value of 250 identical new vehicles as on 31st March 20x9. The volumes and prices across the three markets are as under. You have markets in Uttar Pradesh, Punjab, and Orissa. You have the selling price per vehicle at those markets, the historical volumes sold by Isha Limited, the total volume of vehicles sold in that particular market. So this is a market indicator. Transaction cost per vehicle is given. Transportation cost to the market per vehicle is also given. So you are given all the data. Isha Limited wishes to value the vehicle at 3,91,000. How did they arrive at 3,91,000? They started with 4 lakhs minus transportation cost 4,000 minus transaction cost of 5,000. So this is maximizing the net proceeds, and therefore they chose to value based on this. Because these are the highest net proceeds per vehicle, obviously. So 4 lakh minus 9,000, here it is 3,91,000. 3,80,000 minus 4, 3,76,000. So this gives me, I think, 3,80,000, 3,76,000. 3,69,000. And last one will be 3,31,000. So the question is saying the maximum net proceeds are 3,91,000, which I agree. So 3,91,000. Now the question is, Uttar Pradesh is the largest area for Isha Limited's vehicle. So they say this is the highest net proceeds. Also, UP is the largest market for Isha Limited vehicle. Let us just cross check the facts. Yes, it is the largest market, 10,000. Isha Limited seeks your advice as to whether this valuation would be acceptable under Ind AS 113 fair value measurement. What I want you to do is read the question again and tell me what will be the fair value of the vehicles that it intends to sell. Okay. I give you 5 minutes. It's 7:59, 8 a.m. By 8:05, please share the answer with me. Okay. Read the question again, think, and then give me the answer. Whatever answer you get, fair value, that will be per vehicle. You will have to multiply it by 250 because you are valuing 250 vehicles. Okay. So give me the answers on a per vehicle basis so that you will have to type in less and I can easily determine the fair value computations. Is it okay? Yes. So please try this question. I give you 5 minutes. Okay. Yes. Try the questions, please. Okay, so I already got the answer from Yukta. I'm waiting for the others. Okay, okay. Mohammed has given me the answer. Tanisha has given me the answer. So Geeta has given me the option. I have to choose the answer. सर ये ऑप्शन है आप चूज कर लो. Shruti has given me one answer. Yes. What about others? Manoj, Kiran, Kirti, Viraj. Yadu has given the answer. No, not yet. Yadu is still working. Yes. Shailesh. Okay. Kirti also has given the answer. Geeta's answer is okay. Okay. Yadu, anything you would like to add? I think all of those who are giving the answer 3,96,000. Okay. I got most of the answers at 3,96,000. Okay. Fine. Yes. Okay. Fine. So let us come to the answer. Yes. Geopol also has given the answer. Okay. So now let us understand. सबसे पहले let us understand what are my values. What am I valuing? Because I have seen one answer which is way off track. Okay. So what am I valuing? Sir, I am valuing the fair value of 250 vehicles. That's it. Okay. These are all vehicles which are sold. Big 10,000, 3,000, 750,000, These are all sold. Okay. तो ये नहीं है मेरा. ये बिक गए. So I don't have these assets. And because I don't have these assets, why should I fair value them? This is gone in my profit and loss account. I book the profit and my job is done. The question is, I have what I am selling a division. I am selling a retail division. So this is going under Ind AS 105 as a division which is being sold. And under Ind AS 105, you have to measure it at fair value or the cost, whichever is less. So that is why we are doing a fair valuation. And this division currently has 250 vehicles, which is why we are going to do the fair valuation of 250 vehicles. So this is the first point. तो ये सब multiply किया अगर किसी ने, whoever has multiplied it with this, you should not do it because वो मेरे पास है ही नहीं. Okay. I'm not doing fair valuation of transactions. I'm doing fair value of assets, liabilities, equity. So 250 inventory items are there. Now the question is, which is my, so then this is done. So the definition is fair value is the exit price. The price received to sell an asset. I have to determine the price received in a transaction between market participants in the most appropriate market. So now my question is, which is the most appropriate market? Sir, we will look at the principal market. अगर principal market नहीं होता, then we would look at the most appropriate market. Sir, principal market क्या है? Where there is maximum number of buyers, sellers, transactions, etc., etc. We have seen that. Which is my principal market? And for answering that question, you will not look at this column. This is an entity specific sale. हमें नहीं देखना है वो. I have to look at the principal market from the perspective of the market, not from the perspective of the individual. And therefore, in the principal market, we will look at the volumes and arrive at a conclusion. Punjab has sold 9,35,000, Uttar Pradesh 1,75,000 and Orissa 1,45,000. So clearly, it's absolutely clear maximum number of transactions exist in Punjab, and therefore Punjab becomes your principal market. सर बट हम तो ज्यादा बेचते हैं उत्तर प्रदेश में. वी सेल मैक्सिमम इन उत्तर प्रदेश. हाँ, सो दैट इज एन एंटिटी स्पेसिफिक नंबर ना भाई. द नंबर विच यू आर सेलिंग is your entity specific market. But ultimately, when I talk about the market as a whole, Punjab is the one where you have maximum transactions. So my fair value will be from the perspective of the fair valuation in the Punjab market. Yes or no? Sir, but these 250 vehicles I will sell only in Uttar Pradesh. That is your choice. That is your choice. You may sell, you may not sell. You are selling to a buyer in UK, in Singapore, in America, wherever he sells. For you, based on the data which is given, the principal market is Punjab. That's it. We are not concerned with the fact I am not selling so many vehicles in Punjab. Not at all interested. I am selling it based on my convenience. But these goods are sold maximum in Punjab, and therefore that is the principal market. Now we move on to the next one. If this is the principal market, do I have to think about the most advantageous market? Tell me yes or no. अगर principal market मिल गया, do I have to think which is the most appropriate market, or it is not required? Come on. Yes. Yadu, Geopol, Kirti, Yukta, Muhammad. Tell me, do you have to think about the most appropriate of the most advantageous market? If there is a principal market, I got two answers. No from Namrata and Muhammad, both of them. What about the others? Is not required. Yes. Yes. Geeta, no, you will not think about the most advantageous market. See, look at my explanation. Look at my explanation. Yes. I had told you yesterday only that you will give the first preference. You will give the first preference to the principal market. And if principal market exists, you will not even look at the most advantageous market. नहीं देखोगे आप. And if that is the case, in our question, we have the principal market as Punjab. That's it. Story is over. So then you will only have to determine the fair value in the Punjab market. So in the Punjab market, the available price is 3,80,000 and the transportation cost is 7,000. You will not deduct the transaction cost because that is transaction specific, not entity specific. So 3,80,000 minus 7,000. 3,73,000 is going to be the fair value per vehicle. Fair value per vehicle. So 3,80,000 minus 7. So 3,73,000 is going to be the fair value per vehicle. Multiplied by how many vehicles you have? 250 vehicles. So that comes to 9.325 crores. 9 crore 32 lakhs 50,000. 9 crore 32 lakhs 50,000. Are we clear with this? Yes. There was one answer which was way off track. I presume that it was multiplied with these numbers. I did not check it. It is not right. Obviously, those of you who have given 3,96,000 would have done 4 lakhs minus 4,000. Those of you who gave 3,96,000, you would have done 4 lakh minus 4,000. Considering UP to be the principal market, which it isn't, and therefore 3,96,000 is not acceptable. Those of you who gave 3,69,000, you subtracted everything and gave. Sales price 3,80,000 minus transportation cost 7,000 minus transaction cost 4,000, 3,69,000 लगा दो, multiply कर दो, बात खत्म. No, transaction cost cannot be deducted. You will be deducting only the transportation cost. Is it okay? Yes. Is it okay, everyone? All right. So now the question is, how do we present this answer in the examination? So in this examination, you will have to first write down what is the meaning of fair value. So you will write down fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants in the appropriate market. Okay, in the appropriate market. This is the definition of fair value. Below that, you will write down, in the given case, Isha Limited has sold maximum goods in Uttar Pradesh. However, this is an entity specific information which will not be considered for fair valuation. Which will not be considered for fair valuation. For the purpose of fair valuation, we will consider market specific information wherein Punjab has sold the maximum number of tractors for the period under consideration. Accordingly, the Punjab market becomes the principal market and thereby forms the basis for our fair value calculation. So below that you will write down fair value is equal to available price minus transportation cost is equal to 3,80,000 minus 7,000 is equal to 3,73,000. Therefore, total fair value of 250 vehicles is equal to 3,73,000 into 250. That gives you 9,32,50,000. Finally, you will write that the transaction cost specified for the Punjab state of rupees 4,000 shall be ignored because it is a transaction specific cost and not an asset specific cost. Next to that, you will also write down further the transactions in Uttar Pradesh and Orissa stand irrelevant because in the presence of a principal market, there is no need to determine the most advantageous market. So this concludes all the points what are there in the question. Okay, you have explained the definition. You have said why historical volumes are not considered. You have said why Punjab is considered. You determined the fair value and gave the fair value. You explained why transaction cost is not considered. And you also explained why the most advantageous market need not be considered. So all the legs of the question you have presented in your answer. There is absolutely no ambiguity. If this question comes for 4 marks or 5 marks, you will have 4 or 5 marks in your pocket and you can go dancing out of the examination hall. Okay. So this is how you will have to present your answer. Okay. Sir, the question is not telling directly about the principal market. Answer is according to total volume of transaction. Yes, the question will never tell you directly about the principal market. You will have to take it from the volumes. And in fact, don't you think that itself is the definition of the principal market? Kya tha? You have maximum number of buyers, maximum number of sellers, maximum transactions, which is the case when we selected Punjab. Maximum number of transactions. So therefore, that is the basis we have arrived at. Okay. So that is that. Sir, can it be said that historical volume of vehicles is entity specific and total volume of vehicles will be asset specific? See, these columns, what you are seeing, they are just, yeah. So in this case, it is entity specific. but obviously you have to remember ये तो खाली नाम लिखा है. Okay, they could be writing here as total volume vehicle sold by Isha Limited, total volume vehicle sold in the market. So in that case दोनों में total volume है, so you cannot say that this is the indicator. What is the indicator is this: vehicle sold by Isha, vehicle sold in the market. So this is my indicator. Okay. So I think that this is fairly clear to everyone. Yes. A good, what you can say, a good revision of the concept that we had so far. Yes. So now I give you 3 minutes. 3 minutes. It is 8:20, 8:23 or 8:24. You should give me the answer to this question. Okay. Read this question and give me the answer. Okay. Yes, Manoj. So I expect you to give me the answer to A and B because you got more clarity through the question. So now I expect all those who made a mistake in the previous question, I want all of you to give me the correct answer in case of this institute's test your knowledge question. Aruna Thakkar has given the answer. Oh, new face again. Shruti has given the answer. Very good. Okay, Kirti has given excellent, 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 good, 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 good. Geo Paul has given, Geeta Patel has given. Yes, many of you have given answer to the first part only. Give answer to the second part. Yes, Manoj, I am waiting for your answer. Then Amrita gave the answer. Yadu has given part one. What about part two? What about the others? Mohammed, where are you, my friend? I didn't get your answer. Yukta has not given. Yukta has given. Yes, she has given, but she has given only to part one. What about part two? Who else is there? Viraj, Shailesh, where are you? Okay, fine. So let us start. An asset is sold in two different active markets at different prices. An entity enters into transactions in both the markets and can access the price in those markets for the assets at the measurement date. In market A, the price that would be received is 26. Transaction cost in that market is 3, and the cost to transport the asset to the market is rupees 2. In market B, the price that would be received is 25. Transaction cost in that market is rupees 1, and the cost to transport the asset to that market is rupees 2. You are required to calculate number one, the fair value of the asset if market A is the principal market, and two, the fair value of the asset if none of the markets is a principal market. All right. So, first case, A is the principal market. Do you need to break your head on most advantageous market? Answer is no. A is already the principal market. So, fair value is equal to available price 26 minus transaction cost is 3. We don't consider transaction cost for fair valuation. We consider only the transportation cost. So fair value is 24. Those of you who got this right, and I think all of you got this right. So therefore, yes, all of you got this right. Excellent job. So 26 minus 2, 24 is going to be your fair value. Coming to the second scenario. None of the market is a principal market. So here we have to find out the most advantageous market. So let us look at A. Most advantageous market is the market where the net proceeds are maximized. Net proceeds means available price minus transport cost minus transaction cost. So for A, it is going to be 26 minus 3 minus 2. So that comes to 21. That comes to 21. For B, it is going to be 25 minus 1 minus 2. So this is going to be 22. The net proceeds are maximized in market B. So this is going to be my most advantageous market. Therefore, fair value 25 minus transportation cost of 2. So this is going to be 23. This is going to be 23. And I suppose all of you got, no, some of you have done it as, okay, Yadu got it right. Muhammad, just have it check once again. Yes. Uh, who else is there? Yeah, I think Geopol check, Viraj check, Kirti got it right. Aruna, I think you did not share the answer. Shruti got it right. Tanisha, have a check once again. Yes, that's right. Okay, all right. Fine, absolutely. Yadu is right. Yes, all right. So that's excellent. Okay, good job. So you got this part correct. Good. Are you able to follow? Yes. Are you able to follow? Yes. Okay, perfect. So now we'll do one more question One more question. Yes. And this question, I want everybody to get it right. Okay. I want each and every one of you to get this right. And remember, there is a small twist in this question, which I'm going to share with you. The small twist, I expect that all of you, I expect will be able to navigate the twist successfully. Okay, so presenting question number two. See, these questions are not there in your study module. Okay, but nonetheless, concepts are the same. So I want you to go through this question. The second part I haven't yet taught you. I will teach you and we will solve it later during today's session. But right now I want you to solve the first part. Rohini Limited, a listed company, owns an asset that is traded in different markets, which has to be valued at fair value under ICAI. Rohini currently only buys and sells in the Maharashtra market. The information relating to the asset is as under. You have the Kerala market, Rajasthan market, and the Maharashtra market. The volume of the market in units. This is not Rohini sale. This is the market volume. Kerala market is 40 lakhs. Rajasthan market is 20 lakhs. Maharashtra market is 10 lakhs. The price is given to you. The cost of entering the market, is given to you. The transaction cost is given to you. Cost of entering the market is typically a transportation cost. Okay. Now, okay, fine. Okay. So in this case, there is one assumption. Let me give you this case as solve the question assuming there is a principal market, solve it accordingly. That is option one. Right. So I want you to solve it under two options. First option, principal market exists. Second option, no principal market exists. Okay, like the previous one. Okay, no principal market exists. I want the fair value. Okay. Yes. Thanks, Geeta. You guys are excellent. Keep interacting. Okay. It makes us also stay alert. Yes. So I want you to solve these questions in these two assumptions. There is a principal market and you calculate the fair value. There is no principal market and you calculate the fair value. Come on. Good. Namrata is the moment question comes, he just punches the answer. Yes, that's right. Next, I want others to get the answer. Okay, to give me the answer. This will be in per unit terms only. They have not given number of units held by Rohini. Okay, so it will be in per unit terms. That's right. That's right. Tanisha, part A is right. Absolutely. I'm waiting for others. Geeta, Yadu, Mohammed, my friend, Manoj. Manoj, give me the answer. Geo, Paul, Aruna, Yukta, Kirti. Kirti's first part is right. Geeta, check. Have a check. I think You have deducted the wrong value probably. Have a check. Namrata has given, okay, fine. Second answer is not right, though Tanisha and Namrata have given the same answer. Geo has also given the same answer. Okay, all right. Okay, Shruti has given altogether different answers. Okay, all right, fine. Yadu, I'm waiting for your answer, my friend. Yes. Yukta has left, I suppose. Shailesh, okay. Yukta was typing, so that's good. Okay. Okay, Muhammad gave the answer and Kirti has given the second answer. Okay, fine. So let us start. So first case, I assume that there is a principal market. So obviously, will I look at the situation where I look at individual values? Ek to that information is not given, but I don't need to look at that anyways. I will look at the market where maximum transactions are there. So that is 40 lakhs. That is 40 lakhs. So now this is the principal market. So in the first case, principal market is Kerala because of the sheer volume of transactions. Therefore, fair value is equal to 1330 minus 70. So that comes to not 1, not 70, sorry. 1330 minus 140. So that comes to 1190. Everybody got this right. Everybody, each and every person got this right. So there is absolutely no mistake in this part. Okay. Everybody got this right. Very happy. Really, I'm proud of you. Okay. Somebody gave me 1280. Somebody gave me 1260. Uh, I think you may have done some mistake in subtraction or you may have considered transaction cost in determining the fair value. Okay, so just be a little careful about that. But apart from that, yes, you have done the principal market, Kerala, correct. Now we come to most advantageous market. Now we come to most advantageous market. Okay. Price less transport less transaction costs. Okay. So the available price, now see there is no principal market. So we have to find the most advantageous market. 1330, 1120, 1540. 1540. Less the transportation cost. The transportation costs. What is my transportation cost? What is my transportation cost? Sir, it is 140 for Kerala. It is 140 for Rajasthan. It is 210 for Maharashtra. How many of you have written 210 here? How many of you have written 210 here? How many of you have written 210? And then the transaction cost 70, 140, 140. Yes. How many of you have written 210? I suppose everybody would have written 210. Am I right? Correct me if I'm right. So this comes to 1120. This comes to 840. How many of you wrote 210 here? Everyone. Everyone has written 210. Samohik, everybody has written 210 there. Okay. अब नहीं लिखो सर क्यों सर we always deduct transportation cost correct है but look at the words Rohini currently buys and sells the asset in the Maharashtra market and this is the cost of entering the Maharashtra market. Is it going to enter the Maharashtra market? No. वो खुद महाराष्ट्र में है. So there is no question of entering the Maharashtra market. And therefore, for this particular company, the transportation cost in the Maharashtra market is zero. The transportation cost is zero because the market is already in Maharashtra. I told you before the question started, there is a small twist in the question. Okay. This is that twist. Okay. So when you read the question, please be very alert with the facts. Okay. The entity already operates in the Maharashtra market. उसको market में आने की जरूरत नहीं है, वो already market में. So therefore, the transportation cost is going to be zero. And this is going to be 1440. This is going to be 1440. For coincidentally, वो बोलते हैं ना वो संयोग से, just out of coincidence, you people wrote 210 and this came to 1330 and just out of coincidence, the value is high. So all of you said Maharashtra is the most advantageous market. But suppose transaction cost would be higher in Maharashtra and Rajasthan would be lower, the tables would have turned. You would have said Rajasthan is the most advantageous market. And then your answers would go all incorrect. So nonetheless, one is Maharashtra market is going to be your most advantageous market, but not at 1330. This is going to be at 1400. मेरी तरफ से गलती हो गया टोटलिंग का. This should be 1400. So this is net proceeds. This is net proceeds. It is not fair value, Tanisha. This is net proceeds. Please be careful. This is net proceeds. This is not fair value. Okay. Maximum in Maharashtra. So this is my most advantageous market. And now here, most advantageous market, Maharashtra. Therefore, fair value is equal to available price 1540 minus transportation nil because it's already in the Maharashtra market. So the fair value is 1540. Not only you, don't be sorry, come on, just learn and move ahead. Okay, everybody made that mistake. Sabko लिख रहा है 1400. Okay. So just be a little alert. Okay, so your fair value is going to be 1540. Is it clear, everyone? Yes. Whatever we have been discussing, I have been teaching since yesterday. I suppose with these three questions, that is sorted out. Okay, fine. Namrata, did you follow? Geeta, did you follow? Kirti, did you follow? Geo, all of you who wrote 1330, you have deducted 210. Okay, you got twisted with the twister. Yes, Yukta, did you follow? Who else? Yadu, did you follow? Muhammad, did you follow? Where do we have? Viraj, are you there? Shailesh, are you there? Aruna, did you follow? Yes. Okay. Excellent. Great. So that takes care of this part. Let us move further to the presentations and see what else we can discuss now. Okay, so that takes care of those questions. Please do these homework questions. They are only theory. I have nothing to explain in that. Okay. So now let us come to the next part, that is valuation techniques. That is valuation techniques. I had given you two cases, Yadu. First case, I had told you there is a principal market. Second case, I told you ignore the principal market assumptions. Okay. So that is why, based on that, I had asked the answer. Okay. So if the second part was not given, then you would proceed with Kerala only, like how we did that Punjab wala question. Okay. You would do it that way only. In exam also, they give such a twist. I think so. Yes, that is why the exams are not what you can say, so friendly. Yes, even if you ask me today, I am also afraid to answer the CA final examination. Okay, I'm not sure whether I will also clear the examination. Okay, so you guys need a break, or we discuss for another 15-20 minutes and then take a break. It's voting time. You want a break now, or I take a break at 9 and explain some concepts? What I'm explaining now is very simple, by the way. Okay. Okay. Yadu, I mean, I got two votes for break, one vote for continue the session. I'm waiting for some more answers. ये तो दे ही सकते हो, ब्रेक चाहिए कि कंटिन्यूएशन चाहिए? ओके, democracy, two are saying proceed, two are saying break. Yes. Again, I'm getting Geo Paul is saying continue, Mohammed is saying break. So it is 3:3. Yadu is saying anything is fine. Somebody is saying continue. Okay. So Kirti is saying a break. Okay. What I'll do is I will not take much time. Give me 5 to 10 minutes. I'll stick to some concepts only. I'll leave you for a break before 9. By 8:55, I'll leave you for a break. So everybody is satisfied. Okay. So now we come to the next part, that is valuation techniques. Valuation techniques. Okay. So there is a thumb rule when I arrive at fair valuation. There is a thumb rule. What is that thumb rule? We will have to do the valuation, the fair valuation, in such a manner that we maximize the use of observable inputs and minimize the use of unobservable inputs. This rule, put it in your brains. Okay, ये मेरा fair valuation का thumb rule है. Yes. I'm not receiving your reply, Shailesh. Okay, I got yours now. Okay, so now, when I talk about valuation techniques, each valuation technique will always have this principle: maximize the use of observable inputs, minimize the use of unobservable inputs. What is the objective? I need to estimate the price at which an orderly transaction would take place when quoted prices are not available. When quoted prices are not available. Okay. So we adopt valuation techniques at that point of time. The rule for valuations are maximize the use of observable inputs, minimize the use of unobservable inputs. Okay. Let me explain this with the help of an example. Let us understand with the help of an example. Okay. So we are having, I have taken this example in the previous class also, but nonetheless, okay, what I'll do is, let us take the case of, I'll change the example a little bit. Okay. Let us take a company Dilip Buildcon Limited. Okay. Dilip Buildcon Limited is a company that is in the infrastructure business. You may have heard its name. It is engaged in construction of roads, uh, uh, bridges, railway tracks, runways, airport constructions, part of airport constructions. Okay. Basically, this is an infrastructure company, engineering, procurement, and construction company. So, this is a listed company. This is a listed company. Okay. Now, suppose an entity holds shares of Dilip Buildcon Limited. When it is holding shares, I have to do fair valuation of the share as per Ind AS 109. So fair valuation के लिए I have a couple of methods which are possible. So first method is NSE से NSE में traded है ना सर, तो वहीं से value उठा. So this is the value of the share as it is traded on the National Stock Exchange. ठीक है. Sir, can I also do it in another way? Yes, you can. So, Dilip Buildcon Limited can look at another company in the infrastructure business. So, there is another company, JSW Infra. So, the entity will say, I will look at JSW Infra and then I will adjust some values to arrive at the estimated fair value of DBL. This is Dilip Buildcon Limited. Okay, I can do it. Means what? See, Dilip Buildcon Limited, suppose it has a current ratio of 2:1, a debt equity ratio of 1:1, a positive cash flow, turnover of so much, operating margin so much. Obviously, JSW Infra will not have a similar structure. JSW Infra will probably have a different PE multiple. It could probably have a debt equity ratio, a higher debt equity ratio. It could probably have a particular, what you can say, it could be having a particular current ratio, etc., etc. So I will factor in those changes. I will take JSW. So my process will be something like this. JSW Infra value. This is from the stock exchange. Add or less adjustments to the value. This will be on account of different debt equity ratio, different current ratio, different cash flow position, different profitability ratios. I will make some adjustments. And based on some adjustments, I will arrive at the value of Dilip Buildcon Limited value. Dilip Buildcon Limited value. This is the second approach. The third approach is I will do a DCF valuation, discounted cash flow valuation. I will pick up all the projects. I will somehow find out the cash flow based on discussions with management. I will take a discounting rate. It could be a post-tax cost of capital rate or a post-tax incremental borrowing rate. I will use that to discount the cash flows estimated by the management and arrive at the value of Dilip Buildcon Limited. All these three methods are possible. Now, you tell me, okay, you came to know all the methods, okay? I am asking you one question. सोच समझ के जवाब दो. Which of the three methods is neutral? Neutral मतलब free from bias. Bias मतलब I have a tendency to increase the value of my asset. I have a tendency to increase the value because a higher asset value means a stronger balance sheet. So now my question is, you have three methods. Directly NSE से value उठाओ, JSW Infra with adjustments to arrive at DBL value, and DCF to arrive at the value of Dilip Buildcon Limited. I want you to tell me, where is the bias very high? Where is the bias medium? Where is the personal bias zero? Absolutely no personal bias. What do you think? Yes, market value. Yes. So the neutrality, where are you able to see? Remember, neutrality is essential. It is part of that conceptual framework. You can have a look here. Faithful representation requires neutrality. It requires neutrality. Okay. So now let us come to my case. Tell me, where am I going to be neutral? Yes, Muhammad has also given the answer. I'm waiting for others. Quicker you answer, faster I'll give you a break. Okay? Yes. कहां से न्यूट्रल रहोगे आप? What will be the neutrality? Yes, that's right. Your share, you have invested in DBL. DBL का ही शेयर लिस्टेड है भाई वहां पे. DBL's shares only are listed. So why do you want to go through the rigor of making adjustments to JSW Infra's value or picking up a discounted cash flow approach? That is National Stock Exchange. Maximum transactions happen there. Maximum buyers are there. Maximum sellers are there. No individual buyer or seller can influence the market. It is a perfect market. There is no scope of the value not tending to fair value. And therefore, we are going to take the National Stock Exchange as the preferred value because it enhances my faithful representation. It is a neutral value. There is no management bias in that value. So my valuation technique gives the first preference to the quoted prices. What do you mean by quoted prices? Prices which are quoted on the stock exchange. Prices which are visible for you to just consider without any adjustments. So my first priority will be the level 1 inputs, that is the quoted prices of the assets. Coming to the next level, level 2 inputs. What is level 2 inputs? JSW Infra का quoted value लिया. We made some adjustments to that and we arrived at the value. So therefore, you have your level 2 inputs, which is inputs other than quoted prices. These inputs include quoted prices for similar assets. JSW Infra is operating in the same industry. So similar asset हो गया. I hold a share in DBL. I hold a share in JSW. They are similar business. So I take JSW's price and I make some adjustments requiring certain adjustments. And when I make that adjustments, I will arrive at the fair value computed by using level 2 inputs. And finally, I explained to you DCF. What is DCF? Discounted cash flow. You estimate the cash flow of all the years to come, all the projects DBL has, take its cost of capital, discount it for the tax rate. At every stage, you are having an estimation. At every stage, you are having an unobservable input for which you are introducing a bias, for which you are introducing a management bias. Sir, but हम तो ऐसे है ही नहीं, आप ऐसे नहीं हो. But unconsciously, subconsciously, there may be a bias. You may be a very good human being, I don't deny it. You may not have any intention to do any type of fraud. But कभी कभी वो क्या हो जाता है, that trait comes out that I want to enhance the revenue, I want to show a positive cash flow. वो दिख जाता है. There is an inherent risk of bias in level 3 and level 2 inputs also. But level 3 is totally unobservable. कुछ है ही नहीं देखने के लिए. So therefore, Level 3 is the third and the last uh, inputs options that you are going to have. So level 1, fair value hierarchy, quoted prices. Level 2, quoted price of similar assets or liabilities with adjustments. And level 3 is unobservable. It is done purely using certain assumptions taken by the management. So 1 is greater than 2 is greater than 3. So your preference will always be level 1 inputs followed by level 2 and level 3. Okay. So with that, we take a break now. Yes, we take a break. I've explained valuation technique inputs. We'll continue this discussion after the break. Today the class will be a little long. I'll have to finish the standard because yesterday I left you guys a little early. So, but today we will sit and complete the standard. Okay. So that's it. We take a 10-minute break and then we shall continue. A 10-minute break, please. Okay. All right. Yes. Okay. Welcome back, guys. We discussed the valuation techniques inputs. Yes. Level one, the most neutral, unbiased, observable inputs. We call level one as the observable inputs because we just observe the value and plug it as my fair value. There is no bias, there is no calculation, there is no computation, there is no assumption that is involved. So it is a plain observable input that we apply. The next one is level 2, observable with some adjustments. And the last one is purely unobservable inputs. What is the golden rule for valuation? The golden rule for valuation is that maximize the use of observable inputs, minimize the use of unobservable input. Fair enough. They want to say that be objective as much as possible. That means don't give a chance for anybody to question why this is, why this assumption is made, how it is made, all that. They want to minimize it because they want their financials to present, to give a faithful representation. To give a faithful representation. So with that, we are done with inputs to valuation techniques. I leave this question to you for homework. It's just a simple question. Okay. This is a key principle. If an observable input requires an adjustment using an unobservable input. Okay. Observable input requires an adjustment using an unobservable input. In our example, JSW is an observable input, plus minus adjustment. These are unobservable inputs. So this gives you the value of DBL shares, Dilip Buildcon shares. Now, suppose the value that you have determined here versus the value that is there for JSW. If this variation is significantly higher or lower, कुछ भी हो सकता है. If the variation between this is significantly higher or lower, then the resulting measurement would be under level 3. If it is significantly higher or lower, though it is a level 2 method of computation, we will still put it under level 3 inputs. We will still put it under level 3 inputs. Is it okay? Have you understood? Yes. Now, what is significantly higher or lower? This is not defined anywhere. This is not defined anywhere. It is a judgment call. It is a judgment call. But whenever it is significantly higher or lower, we are going to treat it as a level 3 measurement. Are we clear with this? Yes. Based on that, the same statement is put in an example. You can have a look at it for homework. Are we clear with this? Yes. Okay. All right. So, okay, fine. This also go through, they are just examples, nothing specific for me to explain. They are just examples you can go through to understand. Okay. Like for example, 20, you have an interest rate swap, which is of 11 years, but the rates are available only for 10 years. So you have to do the fair valuation of the interest rate swap. So you take the 10-year value, extrapolate it to the 11th year to arrive at the fair value of the 11th year. So therefore, that goes under level 2 observable inputs. Okay. Level 2, another example you have, which I have discussed. So just go through these questions for homework. Okay. Now, there is one interesting case. Okay. There is one interesting case. Let us discuss this. Okay. I will give you the example, then we will study the theory. Okay. Because I think that example will make a lot of things very clear. Okay. I am referring to a particular case that has happened, but I'm not passing any judgment on that. Okay. So it is from practical life. It has happened, but please don't take that I'm advocating anything or okay. I'm not going into that. Okay. So let us assume that A Limited had invested shares in Adani. Okay. A Limited had invested shares in Adani. Okay. When it had invested, now the market prices, I'm just making it up. Okay. When it invested, the prices were 1500. The prices were 1500. This is the price at the close of the stock exchange. So let us assume that this is on 30th September 2023. Okay. At 4 p.m. At 4 p.m. This is the price of Adani share, the fair value. Okay. At 5 p.m., we had the Hindenburg report that came out. We had the Hindenburg report that came out. Okay. Now, I'm not going into the exact date lines, etc., because I don't need that right now. But yes, so I'm taking this very extreme example so that you remember it and register it for permanently in your minds. Okay. The Hindenburg report came out. It was a severely castigating report. It is still under investigation. I'm not commenting on that. But the impact of this was such that on 1st October 2023, when the markets opened, the fair value of the shares came to 900 rupees. Came to 900 rupees. Now you are preparing your financial statements for the quarter ended 30th September 2023. If you look at the share price, just think and answer now. You are preparing the balance sheet as on 30th September 23. On 30th September 23, what was the market value? Sir, the market value was 1500. Okay. 1st October जब market open हो गया, the value was 900. You are the reader of financial statements. Please remember the fundamental characteristic that is required. Look at the framework. Fundamental qualitative characteristic is faithful representation. I want you to tell me, I have to give the fair value of Adani shares in my balance sheet as at 30th September because I'm preparing the balance sheet. Obviously, 30th September results will be declared somewhere in October or November, certainly not on 1st October. Okay. Let us presume it is declared on 15th October. Okay. 30th September results are published on 15th October 2023. Now, my question to you is, the fair value of shares of Adani, will you state it as 1500 or should you state it at 900 rupees? Should you state it as 900 rupees? Because of whatever has happened. Okay. At the close of the market hours, the value was 1500. The next day when it opened, it became 900. Between 30th September to 15th October, you are actually publishing the results on 15th October for the period ended 30th September 2023. My question, fair value should be 30th September value of 1500 or 1st October value of 900. Yes, what do you think? It is happened like that. The report is released before opening the market, before the market has opened. Yes. What do you think? Put yourself in the shoes of an investor. You are an investor of A Limited. You want to see the results. You would want to see which value. The value on 30th September of 1500 or the balance sheet of 30th September, but there you want to see 900, which is the opening value of 1st October. What would you like to see? Good. I got two answers. I'm waiting for others. Yadu, Shailesh, Gio, Mohammed, Viraj. Okay. This is not an adjusting event as per AS4, number one. Second, I'll not choose to call it as an adjusting event, number one. Second, please don't say AS4. आपका level अभी AS4 का नहीं है. You have to talk in terms of Ind AS. Okay? Ind AS के हिसाब से बात कीजिए. Okay? Okay. All of them are giving the answer as 900, which is right. Which is right. Okay. Now, the question is, what is this? This is an abnormal event that has happened. The markets are closed. The markets are closed. So therefore, you cannot see any price adjustment on 1500. Suppose this report came to me. Suppose this report came to me, came to you. You are a very proactive investor. You look at the balance sheet and you see Adani share 900 rupees. You are very proactive. You go to the National Stock Exchange website, you dig out the values as on 30th September. There you see 1500. You again compare the balance sheet. Here it is 900. You again check there 1500, 900. You will be crazy, right? You will ask, "Bhai, chal kya raha hai? Market value 1500. You are saying you are following fair valuation, level 1 input 1500, neutral value. Kahan gaya neutrality? Why are you taking 900? So now you tell me, what is this fitting in? This is nothing but adjustment to quoted price. I took 1500, which is the quoted price. I reduced it by 600, which is my adjustment. When it does not reflect the fair price. When it does not reflect the fair price. Again, I'm not passing any judgment on the company. But this is the scenario. This is the scenario. Let me make another change to this to reflect, to give you an example of a scenario. Adani's total gas plant caught fire. Okay, let it not. I don't want it. There are no so many workers dependent on the company. But suppose a major fire occurred in the morning of 1st October, early morning hours, and it got published in the paper. There is no event existing on 30th September. There is no event existing. But this fire brought the markets crashing because that was the only major plant of Adani, and now that is totally engulfed by flames. And it was not, suppose hypothetically, adequately insured also. So the market price fell down to 900. Fell down to 900. Is this an event existing on the balance sheet date? Answer is no. आग तो लगी है 1st October को. Markets are affected because it's dynamic. Markets are affected because it is dynamic. But now the question is, do I have to make an adjustment to the value? Answer is yes. You are enhancing the reportability of your figures. But there is a gap. The reader of financial statements is 1500 versus 900. Obviously, a question will be directed to the preparer, the management, that how is this anomaly? So what the standard tells, you will have to put a disclosure. You will have to put a disclosure. Okay. Controls have to be put in place to ensure any adjustments made to quoted prices are appropriate and applied in a consistent manner. Applied in a consistent manner. Now, I want you to tell me the value is 1500. You have disclosed 900. Is this a level 1 input or not a level 1 input? Is this a level 1 input or not a level 1 input? As on 30th September, is this a level 2 input or not a level 2 input? On 30th September, it is not a level 1 input because you are not putting the value as it is. You are making an adjustment. So this goes up to a level 2 input. So you will have to make the disclosure accordingly. You have made certain adjustments to the level 1 input. It could be a positive, it could be a negative adjustment, whatever it is. Let us take the positive side. Suppose it got an approval to construct another 10 airports in India. And that approval came on 30th September, late evening at 8 p.m. The government signed off the papers. This news, when it got published, the 1500 price rose to 2000 rupees. Now you are going to disclose 2000. So therefore, it will not be a level 1 input. Because against level 1 input, you just have to observe and put 1500. But now you are putting it close to 2000. So therefore, you are adjusting it. It will not be a level 1 input. It will be a level 2 input. It will be a level 2 input. Okay. So that is what is this slide all about. Adjustment to quoted price when it does not reflect the fair price. We make the adjustment. Okay. And this you will just go through this for home. Same example what I gave. Only thing is यहाँ पे it is a drug company. एक trial fail हो गया उनका, so therefore the share price tumbled down. Okay, so that takes care of your valuation techniques. And now we shall come to a couple of questions where you are having certain valuations principles. Uh, So valuation techniques, this is basically valuation of equity shares, bonds, instruments, etc. You will study more of this in your strategic financial management paper, but you have three approaches. One is the market approach where you pick the market value straight away. The other is the income approach where you follow the DCF methods like Gordon's formula. The third one is the cost or asset approach where you just pick up the net asset value. Okay, so all these three approaches exist. Whatever approach you are using, that should be consistently followed. If there is a change in the valuation approach, you treat it as a change in accounting estimate as per Ind AS 8. You treat it as an accounting estimate as per Ind AS 8. That is, disclose the reason for that change. Okay, so clear, simple, straightforward, not complicated. Okay. So that takes care of that one. So now let us look at this illustration. Let us look at this illustration. Now we will just solve a couple of questions for our understanding. Before this illustration, let me take you through. Okay. Just a minute. Don't have anything extra. Okay, so now let us have uh, this discussion on some of the valuation related aspects. Okay, because we have some questions related to that, which I feel it would be better if we solve it in the class. I will be taking you through some of the questions, and then basis that we will first conclude the theory related to valuation, see the questions, the solutions, and then come back to Ind AS 113. So right now we are basically looking at our valuation methods, okay, valuation approaches. Ideally, these questions should not be a part of financial reporting, but it has come before, and therefore, best thing is to be prepared for it. Okay. So now coming to valuation methods, you have first one something known as enterprise value. What is enterprise value? Value of debt plus value of equity. So debt plus equity together. In absence of any information, the value of a company given in the question can be considered as enterprise value. Okay, so this is some assumption that is there. To find the value of equity, determine the value, deduct the value of debt from the value of the firm or enterprise. The value of debt is usually interpreted as net debt, that is total debt minus cash and cash equivalents, based on the presumption that cash will be utilized to settle the debt immediately. So what it is trying to say is enterprise value is equal to value of debt plus value of equity. Therefore, value of equity is equal to enterprise value minus KD is equal to enterprise value minus KD. So ये हो गया मेरा valuation of the equity. So we are interested in this value. We are interested in this value. As long as I'm able to get enterprise value and the KD, I can easily get the KD. So with that background, let us proceed to look at this question. ABC acquired 5% equity shares of XYZ Limited for 10 crores in the year X1 X2. Company is in the process of preparing the financial statements and is assessing the fair value at subsequent measurement of the investment made in XYZ. Based on observable input, ABC identified a similar nature of transaction in which PQR acquired a 20% equity share stake in XYZ for rupees 60 crores. Price of such transaction was determined on the basis of comparable companies method CCM minus enterprise CCM enterprise value divided by EBITDA, which was 8. For the current year, EBITDA is 40 crores. At the time of acquisition, valuation was determined after considering 5% liquidity discount, 5% non-controlling stake discount. What will be the fair value of ABC Limited stake in XYZ as on the balance sheet date? Okay, fine. So, I am having a company. Let us first understand what has happened. I am having a company XYZ Limited. Now, in XYZ Limited, ABC has acquired 5%. 5%. 5%. Yes. For rupees 10 crores. Next. Assessing the fair value at the subsequent measurement date of the investment made in XYZ Limited. So it wants to do a fair valuation of this. It wants to do a fair valuation of this. Based on observable input, ABC Limited identified similar number of transactions in which PQR acquired 20% share in XYZ Limited. Okay. 20%. How much it had acquired this for rupees 60 crores. कितना है 60 crores. Okay. Now 60 crores. The price of such transaction was determined on the basis of comparable companies method, enterprise value by EBITDA, which was 8. Is equal to 8. Okay. Now, for the current year, EBITDA of XYZ is rupees 40 crores. At the time of acquisition, the valuation was determined after considering 5% liquidity discount, 5% non-controlling stake discount. What will be the fair value of ABC Limited's investment in XYZ? Okay. So, I need to value this. And to value this, I will look at this. To value ABC Limited stake, I will look at PQR Limited's purchase of stake, right? Now, the issue is not so simple. You just cannot say 20%, 60 crores, so 5% is how much? No. You will need to understand that we are going to have certain adjustments because this is a higher shareholding. You may even get an opportunity to sit at the board with such a shareholding, but that will not be available with ABC Limited. That will not be available with ABC Limited. Next one. Okay. So we start off with that and then let us proceed further. Okay. Enterprise value is nothing but EV by EBITDA. They have given that to be 8. EBITDA of XYZ from PQR transaction is 40. Yes. So therefore, enterprise value of XYZ comes to be 320 crores. This enterprise value is for the transaction of PQR Limited. This is for the purpose of PQR Limited. Are we clear so far? Yes, are we clear? We are having EV EBITDA multiple of 8. All right. And the EBITDA right now is how much? The EBITDA right now for the current year, EBITDA of XYZ is 40 crores. For the current year, EBITDA is 40 crores. All right. Yes. So therefore, enterprise value is going to be 320 crores. Is everybody clear here? Is everybody clear till now? Yes, is everybody clear till now? Just give me a minute. Okay. All right. Okay. All right. So now, based on this transaction, the enterprise value comes to 8 into 40 is equal to 320 crores, is equal to 320 crores. But tell me one thing, is this transaction a representative of this transaction? Answer is no, it's not. Because this transaction is for a 20% stake, which could probably give a seat at the board, some liquidity discount, etc. may be there. And therefore, this transaction is not a representative of the ABC Limited's 5% acquisition transaction. And therefore, we need to make some adjustments to this. We need to make some adjustments to this. So what are the adjustments that I'm going to make? Well, first one is that is for 20% stake. So for a 5% stake, it will be 320 into 5%, that is 16. That is 16. Now, I am having a 5% liquidity discount. I am having a 5% liquidity discount. So 16 minus 0.8. And I am having a 5% non-controlling interest discount. That means I will not be able to exercise a significant influence. The 20% will give a significant influence, but the 5% need not necessarily give a controlling a significant influence or a seat at the board. It's just a share. So that discount of 0.8. So the fair value of this investment would drop down to 14.4 crores. Would apply to 14.5 crores. Are we clear with this? Yes. So I have here explained to you what do you mean by liquidity discount. It is applied if the stake held is illiquid. That is, it would be subjected to some lock-ins or restrictions or minimum period of investment, etc. In the given stake, the illiquidity is valued at 5% of investment value and hence 0.8 crores is deducted. Since illiquidity is a negative characteristic. And finally, you have a non-controlling discount, That is probably there is a board share for EQR, which I do not have. Liquidity discount, I am not able to sell my shares. Non-controlling discount, my shares do not give me a right to sit on the board of directors of whatever company. Okay, so that is the meaning of non-controlling discount. Is it okay? Have you understood this? Yes. By acquiring only 5%, ABC does not have any significant influence. Okay. So that takes care of this question. So the fair value of investment in XYZ is 14.4 crores. Are we clear with this? Mohammed, did you understand liquidity discount? Did you understand liquidity discount? Yes. Everybody understood this question? Yes. Anybody has any doubts? Okay, all clear. Shailesh has confirmed, Geeta has confirmed, Mohammed has confirmed. Good. So this is one way of solving the questions. Okay. Now you are given another question based on income approach. So I have done this question right now. Now we are doing this question. Okay. So now UK Limited is in the process of acquisition of shares of PT Limited as part of business reorganization plan. Projected free cash flows of PT Limited for the next 5 years are as follows. You are given the projected cash flow. Weighted average cost of capital of PT is 11%. Total debt as on measurement date is 1,465 crores and the surplus cash and cash equivalent is rupees 106.14. Total number of shares as on the measurement date is 8 crore 52 lakhs 84,233. Determine value per share of PT Limited and as per income approach. Examines of the information from in or top question. Value of enterprise is equal to PV of all future cash flows. Cash flows estimates of cash flows in years 1 to 5. Terminal value estimate of cash flows to perpetuity. Year 6 to perpetuity. Okay, so this takes care of. Okay, so now we are having. Yeah, Harsh, I let you know that. Okay, I let you know that. Okay, the problem solving session, I will let you know. I'll discuss with the institute. Okay, now look at this question. We are having future cash flows. We are having future cash flows. Weighted average cost is given. Debt as on the measurement date is given, and the surplus cash and cash equivalent is also given to you. So now, how do I start to solve? How do I start to solve? Valuation is done as per income approach. Yes. We are given future cash flows, including the terminal value as well as the weighted average cost of capital. We follow the discounted cash flow approach for determining the value of an equity share of PT Limited. Okay. So we follow the DCF method. Now, the discounting factor 11%. So I take the cash flows 187, 187.1, 68, 269, 278. And finally, you have a terminal value. You finally get back your terminal. So that gives you years 1, 2, 3, 4, 5, years discounting factor. So this gives you the present value of the cash flows minus net debt after adjusting cash and cash equivalents. So that gives you value of equity divided by number of equity shares to arrive at value per equity share. Are we clear with this? Yes. Are we clear with this? Yes. Are we clear with this? A simple question, but just slightly technical. That's it. Okay. Shruti and Yadu. What about Tanisha? Did you follow beta? Okay. Everybody has confirmed. So let us then proceed to the next one. Okay. All right. I want you to try question number 5, slide 37 by yourself. I leave this as homework. It is a combination of the first two questions that we did. I also want you to also try slide question number 2, slide number 46, 47. Oh, wait, this first part we have done. Yes. Okay, fine. Fine. Second part is fine. So I'm leaving you with this one question for homework. This is done. This I have done. I'm leaving you with which question? Which question? Slide 37. This I have given you for homework. Homework. Yes. This we have discussed. This we have discussed. Okay. Value of equity cannot come negative. Okay. Value of equity cannot come negative. If negative, then your assumptions are incorrect. Okay. At the most, it cannot even be zero. Okay. It cannot even be zero. Okay. All right. Fine. Okay. So that takes care. Acha, just tell me one thing. Have you received these presentations and this sheet? Have you received these presentations and this sheet? Yes. Okay, fine, good. So you have received this means it's good. Okay, all right. These are based on similar concept. So go through this also. I'm leaving this for your homework. Okay, you can do it. It's simple. Okay. Coming to the next part. So far, whatever we discussed from yesterday is with the help of assets. Is with the help of assets. It was easy to discuss. You would not have any difficulty because you are familiar with the concept of assets. But we have to do fair valuation for all the items. It could be fair valuation of my own liabilities like borrowings, trade payables, etc. It could also be fair valuation of my own non-financial liabilities like advance received, etc. Or it may even be fair valuation of my own equity instruments. For example, instruments which I issue under a business combination arrangement. So when all these items are there, we obviously need certain guidance because we don't deal with what you can say. We don't deal with these items on a regular basis. We are more comfortable with the assets. So now, how do I interpret this? Well, when we talk about applying fair valuation to the liabilities, it means one and only one thing. I am transferring the liability. I am not settling the liability. That means liability abhi tak hai. Liability is still there. But this liability is now no longer my responsibility. Is now no longer my responsibility. Okay, this is entirely opposite to the assumptions that liabilities get settled. Okay, here no settlement. My burden, I shift it to somebody else. For the shifting of that burden, how much I have to pay. That is what we will have to understand. So when I talk about fair valuation rules to liabilities and own equity, the original fundamental rules remain. That means maximize the use of observable inputs, minimize the use of unobservable inputs. Maximize observable, minimize unobservable. And Ind AS 113 specifically provides guidance on the scenarios while evaluating fair values of the liabilities and own entity instruments in case direct quoted prices are not available. Are we clear with this yet? So therefore, how do I proceed with liabilities or equity instruments valuation? The first one I will see is if these liabilities or equity instruments are held by other parties as assets, are held by other parties as assets. What does it mean? Arey, this is a defined liability. A provision nahi hai. This is a liability. That means when you issue debentures, somebody procures the debentures. That means somebody is going to pay you for those debentures. Yes, somebody is going to. I mean, somebody is going to. What you said, somebody is going to demand you the money for those debentures, yes or no? So therefore, when I look at valuing my liabilities, I will think of it as मेरा लायबिलिटी किसी और के बुक्स में एसेट है. माई लायबिलिटी इज एन एसेट फॉर somebody else. How is that person valuing? How is that person valuing? Okay, so that means if that entity uses the quoted price, if that entity uses the quoted price, then we do have a quoted price for our debentures. We do have a quoted price for our debentures, and accordingly we will use the quoted price for those debentures. Are we clear with this? Yes. Are we clear? So first step is use quoted price for identical market. Use quoted price for identical market item held by another party as an asset. Held by another party as an asset. This is the first preference. Second preference, quoted prices is not available. Use other observable inputs such as quoted price in a market that is not active for the identical items held by another party as an asset. So this is reference 2. Reference to quoted price is not available. Okay. Preference 3, if observable prices in 1 and 2 are not available, use a valuation technique such as income or market approach. Such as income or market approach. Is it okay? So we have three options to do the fair valuation of our liabilities. First one, use the active market in Goa. Use of the active market in this thing, in that of the active market for the identical item. Preference 2, if quoted prices is not available, then we will use other observable inputs and make adjustment. And if observable inputs are not available, we will be using a valuation technique. However, if we look at the case where my liability is not an asset for the counterparty, where my liability is not an asset, sir, ऐसा हो सकता है. Have you studied Ind AS 16? Have you studied Ind AS 16, my friends? Yes. Fixed assets, property, plant, and equipment. Have you studied? Have you studied property, plant, equipment? Ind AS 16 पढ़ा है आपने? Yes. So in Ind AS 16, you would have studied something known as decommissioning and restoration liability. Have you studied this? Decommissioning and restoration liability. Have you studied this? Have you studied decommissioning and restoration? Yes. You have an oil rig किसी seabed पे जाके you install it, and then after 10 years, 15 years, when you have extracted the oil from the oil rig, you are required to, okay, fine. See, what is a decommissioning liability? What is a decommissioning and restoration liability? See, suppose you install an oil rig. Are you able to recollect? Let me just see if you can recollect. Okay. I have an oil rig that is installed today. Oil rig. What is today's date? 1st April 2022. I installed the oil rig on 1st April 2022. The terms of the contract require that after I finish extracting the oil, then I will have to remove the oil rig, and I had drilled in the seabed. So I must restore that seabed. Okay. The seabed is a very sensitive piece of the planet. So whatever drilling I had done, I will have to restore it back, bring the oil rig to the shore. इसको हम लोग बोलते हैं decommissioning. I decommission the oil rig. Decommission means उठाना. I remove it from there and I restore it. जो मैंने ड्रिलिंग के लिए आई हैड डन द एक्सकवेशन, द ड्रिलिंग, आई एम नाउ filling that seabed. I am making it as good as it was before the time I was drilling. So this is going to be done after I finish extracting the oil. So this would be typically, let us say 2032. 2032. That means a period of 10 years. That means a period of 10 years. You tell me, when is the liability of oil rig decommissioning and restoration? When does the liability of decommissioning come into existence? Does it come into existence on 1st April 2022? Does it come into existence on 31st March 2032? When do you have the liability coming into existence? कब है वो liability? सोच के बताना. Yes, when do you have this liability coming in existence? When do you have this liability coming into existence? 1st April 2022. Geeta, what do you think? Shruti, what do you think? Yadu, what do you think? When is the liability coming into existence? Is it coming into existence on 1st April 2022, or is it coming into existence on 31st March 2032? सोच समझ के जवाब दो. Think and answer. You have studied this. Yadu gave the answer, which is right. Kirti has given the answer, which is right. Shailesh has given the answer. I'm waiting for others. Okay. Mohammed has given the answer. Geeta has given the answer. Shruti, what do you think? When is the liability come into force? Manoj has given the answer. Very good. Thank God children are there. I was under impression very less people are there. Yes. Okay, so let us answer this question. See, your restoration liability exists the moment you make the first hole in the ocean seabed. You are making the first drilling on 1st April 2022. आपने जैसे ही वो ड्रिल चलाया, it may be for a fraction of a second, but the moment you make that drilling, that is the moment your liability has arisen to restore it. Your liability arises to restore the moment you make the first drill in the seabed. Sir, but payment to 10 साल बाद, that is the payment, my friend. That is the payment. That is your obligation to set to restore and return it back. You have time till 31st March 2032. लेकिन when did this liability get born? इसका जन्म कब हुआ? When did this liability arise? The liability arose when you made the first hole in the seabed. जब आपने ड्रिल चलाया सीबेड पे, that is the time, and that you did on 1st April 2022. But sir, हमको तो पता ही नहीं. I do not even know what will be the restoration cost after 10 years. आप चाहते हो हम आज ही अकाउंट करें? Yes. You have to do it because it is an obligation. You have to do it because it is an obligation. It is a contractual obligation. Typically, these obligations are mentioned in the contract itself. Earlier, what used to happen is this decommissioning, I would book it entirely on 31st March 2032 when I would do the decommissioning. But now India tells us no. The provision or the liability to clear it arises on 1st April. So here I have to book the liability. But can I credit a party? Can I credit a creditor? Answer is no. I do not know who will do the decommissioning, restoration, kisko bulaunga, kya karvaunga. I am not aware of it. So therefore, I will create a provision for decommissioning and restoration. I will create a provision for decommissioning and restoration. What will I debit? Sir, P&L. Arre, no, you will not debit the P&L. Whole purpose is to protect the profit and loss account. So what I will do is I will debit the asset account. I don't want to see uneven swings in my P&L. I do not want to see uneven swings in my P&L. So therefore, I will be passing this entry asset account debit to provision for decommissioning and restoration. Now, when I say asset account debit to provision for decommissioning and restoration, this particular, now I will come out of Ind AS 16. Uske baad you do the asset account, you depreciate it. Decommissioning, you do the amortization, unwinding of discount and bring it to the value on 31st March 32. But I'm not going into that. That is a different standard. My focus is this account. This account is a liability. You have to fair value this. Suppose you are doing a business combination and you are transferring the oil rig with all its liabilities and everything. Iska fair valuation karna padega. The rule for liabilities was fairly simple. What was it? If your liabilities or equity are held as assets by counterparties, then use the quoted price of those assets or use some non-observable inputs, level 2 inputs and do the valuation by using comparables. Or third one, unobservable if observable inputs are not at all there. Basically, this is the hierarchy, level 1, level 2, level 3 hierarchy you will have to follow. However, you tell me this provision for decommissioning and restoration. As on 1st April 22 or March 23, March 24, March 25, whatever it is, do you know who is going to carry out this job? You need people, you need equipment, you need cranes, you need huge amount of manpower, you need specialized equipment to lift that oil rig. You need manpower supplier, you need everything. Do you know that on 1st April 22, 23, 24, whenever it is, do you know who will do the job, whom you will give the contract to? Do you know that? Yes. Do you know? Bolo, do you know who is going to do this contract? As Reliance, which has put in an oil rig, 10 साल बाद रिलायंस को पता होगा कि कौन करेगा ये decommissioning. Not knowing, you cannot know this. अपने को मालूम नहीं. I only have estimated the cost. So therefore, I do not know for whom this provision for decommissioning is. For me, it's a liability. But counterparty, is this an asset? When I only don't know who will do the job, who will have the contract of this? You think somebody in the dream will come to know, acha, ye contract mere ko aayega, let me book an asset right now. No, he cannot. So therefore, against this liability, I do not have an asset. I do not have a corresponding asset in somebody else's books. This is not my own books. Held by other party as assets means in their books it is an asset, in my book it is a liability. Whereas in this case, not held by other parties as assets means what? It means that I have made a provision, but there is no corresponding beneficiary of this provision. So therefore, I cannot compare, I cannot apply this. I cannot apply this chart. I cannot apply. Why? Because वो किसी और के books पे asset ही नहीं है. And therefore, what am I going to do? I will have to do a valuation. I will have to do a valuation using a valuation technique. That means level 3 inputs. Level 3 inputs. Are we clear with this? Yes. Are we clear? Yes. So therefore, we will have to do the valuations accordingly. Level 3 inputs. Anybody has any doubts? Anybody has any doubts here? Yes. All clear? बोलो. Yes. Clear. Okay, fine. So therefore, if I have to look at applying fair value rules, this is a simple chart. Is there a quoted price to your liability? Are your debentures traded on the market? Yes. So take that price, that is the fair value of your debentures. Use the quoted price. Acha, if it is not traded, is there an identical item held as an asset by another party? Yes. If yes, and it has a quoted value, answer is use fair value of identical asset. Adjust quoted price only if factors specific to the asset but not to the liability or own equity are present. Alternatively, if it is not an asset, you will have to apply present value technique, including expectation of cost and compensation. So we use a valuation technique here. So this is going to be your guiding principles for liabilities and own equity. The fair value of the liability that I am determining, it reflects non-performance risk also. It reflects the transfer restrictions also, and financial liability with a demand feature, it cannot be less than the amount payable on demand. It cannot be less than the amount payable on demand. Are we clear with this? Yes. Are we clear with this? Any doubts? Anybody has any doubts? Yes. Yes. Are we clear? Please confirm. Understood the chart? Yes. The fair value will encapsulate credit risk, transfer restrictions, as well as non-performance risk. So you don't need to do any further adjustment. Okay. See this one. This, I hope you understood this slide number 42. Okay. Now, when I determine the fair value of this asset, the fair value, see, I am valuing the liability. I am valuing my liability. So, in other words, let me just explain. Suppose I have a debenture and I am valuing this debenture. Okay, मैंने debenture issue किया है, debenture issued. Okay, and I need to do a fair valuation of this. Now, when I do the valuation of this debenture, suppose it is quoted on the market. Suppose it is quoted on the market. उसको हम लोग बोलते हैं fair value because it is an observable input. Okay, so this is a debenture which I have issued. Now, the fair value of this debenture reflects my ability to repay or not to repay. Yes or no? I obviously बात है. Yes. See, suppose you give a debenture to, you are the investor, you make an investment in the debenture of Jet Airways today. Jet Airways is virtually कुछ है ही नहीं उसका. They don't have anything. What do you think will be the value of the debenture? Suppose face value is 1,000. Will you pay 1,000 or will you say I'll pay you some few 1 or 2 rupees because उतने का ही value है. I don't know how much you will repay back. Won't the market have similar sentiments? Won't the market have similar sentiments? Yes or no? Won't the market have similar sentiments? It will have similar sentiments. That means the market value of your debenture is reflecting the risk of non-performance. That means today when a debenture of Jet Airways with a face value of 1,000 has a price of 2 rupees in the market, it is reflecting what? It is reflecting the fact that Jet Airways cannot repay this debenture and therefore the value of that is only 1 or 2 rupees. Face value is rupees 1,000, but market value is equal to rupees 2. Why is this 2 rupees? Because Jet Airways cannot repay this. Jet Airways is unable to repay 2 rupees. Also is unable to repay 1,000 rupees, and therefore the market has a sentiment that Jet Airways' non-performance risk is very high, and because non-performance risk is very high, the market value of that debenture is very low, and therefore this is the gap. This is the huge gap that we are going to see. Similarly, there may be some transfer restrictions also. I will be unable to transfer this particular bond or debenture or whatever it is. So that also will be factored in the market price. That will also be factored in the market price. Are we clear with this? Yes. Are we clear? Did you understand, Geeta? Did you understand? Yes, all right. And finally, a financial liability with a demand feature. What do you mean by demand feature? Suppose I have taken an overdraft from the bank, overdraft or cash credit from the bank. कल को बैंक एनी टाइम उठ के पूछ सकता है गिव मी द मनी. ये ऑन डिमांड loan hai. It is an on demand loan which is there. Okay, so the fair value cannot be less than the amount payable on demand because ultimately that demand is going to come. Very simple. Let me give you another example. Suppose you have made an FD with Axis Bank. Is this a liability for Axis Bank? Yes, it is a liability for Axis Bank. Which type of liability? Sir, it is a demand liability. What do you mean by demand liability? Today you want money. Suddenly, there is some emergency, you want to break that FD. आप जाके एक्सिस बैंक काउंटर में you can demand Axis Bank officials break this FD, give the money back to me. Will you settle for anything less than the principal? Plus accrued interest? Answer is सवाल ही पैदा नहीं होता sir. There is no question of me accepting below the principal plus accrued interest because that is my right. So therefore, for the bank, the fair value of this fixed deposit liability cannot be less than the amount payable on demand. It cannot be less than the amount payable on demand. At the same time, it will have to be discounted from the date the amount could be required to be paid. Obviously, suppose the fixed deposit has a lock-in period of 5 years, your tax saving FD. Then It is a liability payable on demand. Only thing is it is coming with a lock-in period of 5 years. And therefore, the dues after 5 years, you discount it today and report it at the present value. And then you unwind the discount and take it to the future. Are we clear with this? Yes. So your liability fair value encapsulates transfer restrictions as well as non-performance risk. And where the liability has a demand feature, in that case, the fair value cannot be lower than the amount payable on demand because it is the counterparty asset holders right to collect the minimum amount. Okay, so that is what is your fair value rules. Okay, so go through this question. It's very simple. It's just an example. Okay, all right. Now we take up one question which is particularly interesting. Okay, and then we shall continue. And then we shall continue. Okay. Okay. So now we had done that Rohini question. You are aware of it. I told you I had done the first part. This part is done. I told you I will be taking up another part. Yes. So this is the second part where we are valuing the decommissioning liability. Tell me one thing. Decommissioning liability. Is it an asset for a counterparty? Quick. Decommissioning liability. Is it asset for a counterparty? Answer. Is it asset for a counterparty? Is it asset for the counterparty? No. If it is not an asset for a counterparty, can I apply market valuation techniques? Can I say that this is the quoted price? I will apply this? Answer is no. If I cannot apply L1 technique, that is observable inputs, L2 observable with adjustment, I will have to apply which one? I will have to apply L3. What is L3? Totally unobservable input, completely unobservable inputs. And therefore, I will have to do my valuation based on valuation technique number 3. That means I will have to do the present valuation of the future cash flows. I will have to do a present valuation of my future cash flows. Are we clear with this? Yes. So that is exactly what I'm going to do now. I'm going to do a present valuation of the future cash flows by discounting whatever I'm expected to incur at the end of the tenure. I will bring it to the present value and show that this is going to be my fair value. Are we clear with this? Yes. Are we clear? Yes. Here, you have to first understand what is the type of asset or liability you are valuing. And then you will have to proceed to do the valuation accordingly. Okay. All right. So let us start. Additionally, Rohini acquired an entity on March 20x2 and is required to fair value a decommissioning liability. Okay. The entity has to decommission a mine at the end of its useful life, which is in 3 years' time. So I am today, the decommissioning will happen after 3 years. So the discounting will be for a tenure of 3 years. The discounting will be for a tenure of 3 years. Rohini has determined that it will use a valuation technique. It has to use the third valuation technique of unobservable inputs to measure the fair value of the liability. If Rohini is allowed to transfer the liability to another market participant, I told you, whenever we are doing liability fair valuations, the fundamental bedrock assumption is the liability is not getting settled, the liability is getting transferred. The liability is not getting settled, the liability is only getting transferred. Matlab, there is still a settlement against this liability. You may not do the settlement, outside party will do the settlement, but a settlement will happen nonetheless. And therefore, it has to use a valuation technique to measure the fair value of the liability. If Rohini is allowed to transfer the liability to another market participant, following data is to be used. Labor and material cost 14 crores, overhead 30% of labor and material cost, annual inflation rate 5%, risk adjustment, that is cash flow uncertainty, is 6%, third party markup is 20% industry average, risk free rate of government bonds is 5, and non performance risk is 2%. Non-performance risk is 2%. Discuss with relevant computations how Rohini should measure the fair value of the above asset and liability under Ind AS 113. Under Ind AS 113. Okay, fine. So let us look at the solution. I already have plotted this for us. Okay, so we can just take a look. Okay. Okay. So first thing, why do I need fair valuation? So this is a business combination. Okay, you will study business combination. In business combination, all assets and liabilities taken over are to be fair value. So I'm doing the fair value. Liability must be measured at fair value under Ind AS 113 rather than using best estimate measurement. In most cases, no observable market to provide pricing information. And therefore, if this is the case, Rohini will use expected present value technique to measure the fair value of the decommissioning liability. If Rohini were contractually committed to transfer its decommissioning liability to a market participant, it would conclude that a market participant would use the inputs as follows. Okay. So how do we arrive at this value? Let us look at it. Okay. 14 crore labor cost, overhead 30% of material and labor cost. Okay, so 14 crore labor. I'm incurring this after a span of 3 years. Don't forget that. I'm incurring this after a span of 3 years. So 14 crores plus 30%. So that gives you 18.2 crores. That gives you 18.2 crores. I have taken this, I have taken overheads. Now let us move on to the next one. Third party markup industry average 18.2 crores into 20%. Where is that third party markup industry average? Yes, this is a third party markup which you can be charging, So that is 18.2 crores into 30%. Sorry, 20%. 18.2 into 20%, 3.64 crores. So total is 21.84 crores. Total is 21.84 crores. Are we clear with this? Yes. Now, this one is at today's prices. Payment will happen after 3 years. Yes or no? Payment is going to happen after 3 years. So annual inflation impact only is going to be 21.84 crores into 1.05 raised to 3. Why? Because this is compounded over a tenure of 3 years. Are we clear with this? Yes, are we clear with this? Why 3 years? Have you understood? Why is this 3 years? I hope you have understood this. 1.05 raised to 3. Bolo. Yes. So therefore, after a tenure of 3 years, the value is going to be 25.28 crores. 25.28 crores. Now, I have a risk adjustment cash flow uncertainty. See, I'm just projecting my calculations, but I need to have a contingency plan. So that contingency is taken as 6%. So add risk adjustment 6%, 1.5 crores. So this comes to 26.8 crores, 26 crores, 79 lakh 94,818. So this is my risk adjustment with cash flow uncertainty. Now this is what I expect will be the fair value of the liability after 3 years. I need to discount it to the present value. So for discounting, what rate are you going to take? Sir, we will take risk-free rate of government bonds plus the non-performance risk of 2%. So therefore, 4 plus 2, that is going to be 6%. That is going to be 6%. So that gives you your net liability as 22.5 crores. 22.5 crores. This is going to be your fair value of the decommissioning liability today. Are we clear? Yes. See, this is what is my unobservable input. What is observable here? What is observable? See, labor and material estimate, overheads estimate, inflation estimate, risk adjustment, cash flow uncertainty, government bonds, third party industry average, all of these are estimates. Yes, entities non-performance risk is also going to be an estimate. Yes, all of these are estimates. All of these are estimates. And you are having only one figure which is kind of known to you on account of the cash flows which you are going to incur. So that is 21.84 crores. On that you add that provision, on that you add that what you have to say. You will add the provisions, the overheads, labor, all put together, and then you will do the inflation adjustment and complete. So that takes care of this working. 22.5 crores should be the value of the assets and liability. Asset we have completed, liability we have done. Okay. Are we clear with this? Yes. Are we clear with the example? Yes. Can you try it out, please? Once. Can you try it out, please? Yes. I'm almost on the verge of completing the standard. So is it clear? Have you understood? Yes. Anybody has any doubts? Please feel free to ask. Okay. So this is the one. Next, let us move on to the next one. So this question is fully attempted. Okay. Now we move on to the next. Small parts are there. So I want you to do this question. Homework. Same question. A Limited assumes a decommissioning liability legally required to dismantle and reassemble after 10 years. Contractually allowed to transfer to a market. But see, language also is the same. Language also is same to what we did just now. Okay. So labor costs are developed based on current marketplace wages, assigns probability, cash flow estimates probability, overheads at 80% of labor. Compensation would be a profit markup of 20%, same like what we have seen. Risk that the existing cash flows might differ from the expected ones, the premium is 5%. Effect of inflation 4% over 10-year period. Time value of money 5%. Non-performance risk 3.5%. Concludes that the assumptions would be used by market participants. In addition, A Limited does not adjust its fair value measurement for the existence of a restriction preventing it from transferring the liability. Required calculate the fair value of the asset retirement obligation. Is this question greatly different from what we did just now? Is this question very much different from what we did just now? I don't think so. Okay. I'm not, I don't think so. So I think you should be in a position to attempt that question. You should be in a position to attempt that question. Okay. It's almost exactly the same. It's almost exactly the same. So let us move on to the next small two, three subtopics are there and we are done. Okay. So sometimes you are having offsetting positions in the market. Okay, you are having offsetting positions in market risks or counterparty risks. Okay, offsetting means a payable receivable. I am permitted to knock it off. Okay, ideally should not, but in some cases we are in a position to knock it off. Okay, now market risk, trade receivables, USD, liabilities also could be in USD, right? So there could be a forex loss, there could be a forex gain. Okay. Now, when I do fair valuation on net basis, price receivable to sell net long position, price payable to transfer net short position. So what is required is documented strategy, info to managerial personnel, and fair value at the end of each reporting period. So that is a fairly simple slide to discuss. Okay, you can go through this theory. It does not have any practical question or implication. Just go through it for your satisfaction. Now the last one is fair value at initial recognition. See, what did we start with? You guys remember yesterday when I started, I told you that fair value is an exit price. Fair value is an exit price. Do you recollect this statement? Fair value is an exit price. Yes. Do you recollect this statement? Yes. Throughout the period, I have been telling exit, 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 exit. If it is exit price for you, it is an entry price for the counterparty. Yes or no? If you are thinking about what will be the price to sell, the counterparty will think what will be the price to receive. Yes or no? Yes or no? So therefore, if I have to look at the case, an exit price for one will be the entry price for the other in all cases except four scenarios. So when I talk about fair value, it is an exit price, but it is also the entry price. It is also the entry price except in four scenarios. Except in four scenarios. Okay. In these four scenarios, if the condition falls in, then exit price will not be equal, sorry, entry price will not be equal to the fair value. Yes, are you able to follow? Exit price is my Ind AS 113. This is equal to entry price. This will automatically be the fair value. But in four cases, exceptions, four cases, four cases. What are those four cases? First one is related parties. Always there is a problem. I told you related parties are not easy to shake your heads off. It is a very serious issue. So whenever you have entered into a transaction with related parties, they are not going to be treated as at fair value. They are not going to be treated as at fair value. Are we clear with this? Yes. Are we clear with the first case? Yes. Are we clear? The second scenario is sale is under duress or forced sale or coercion or stress or distress, whatever it is. Yes. So therefore, they are forced to sell the asset or under duress to sell the asset. Okay. Related parties, second one is under duress. Obviously, it cannot be fair value. The third one is different unit of account. You remember unit of account once upon a time I had explained to you. One asset, one liability, or all assets, liabilities together. You recollect? Yes, unit of account. So suppose Ind AS 113 has sold a division which comprises of inventory, which comprises of debtors, which comprises of inventory is done, debtors is done, assets, property, plant and equipment, manpower, or forget manpower formula. Okay, property, plant, equipment, etc. Okay, so keep it. Okay, keep it aside. Now, what is the deal? The deal is the entity selling the division sells it as a slump sale. Sells it as a slump sale. What do you mean by slump sale? Individual items are not identified. Individual items are not identified. Are we clear with this? Yes. But the counterparty that is receiving the goods, it cannot do a wholesome division account and dump it in its books. Can it do that? Answer is no, it cannot. It has to recognize inventory, debtors, assets, property, plant, equipment, everything separately, systematically. So therefore, for the entity selling the division, the unit of account is assets, liabilities put together. But for the entity receiving the goods, receiving the division, it is separate item. It cannot be all of it put together. So the fair value measurement by the receiving entity will be itemized. You will have a purchase price allocation report and do an itemized fair valuation exercise, because you have to bring the debtors in your books, the inventory in your books, the asset in your books. You will have to record the liabilities in your books. Everything has to be accounted. Everything has to be accounted. Are we clear with this? Yes. But the counterparty is doing it as a slump sale. उसको तो निकलना है मार्केट के बाहर, so it will do a slump sale. I am doing a slump sale, and on the other side, I have to record it individually, asset and liability wise. It becomes different units of account, and therefore the fair value at initial recognition does not get what you can say, different unit of account does not get comparable, does not become comparable, and hence we cannot equate the two of them. And finally, fair value at initial recognition, not the transaction has not happened on a principal or most advantageous market. If that be the case, then the fair value, the exit price will not be equal to entry price, will not be equal to the will not be equal to the entry price. Yes. So that is under these four cases. Related parties, under duress, different unit of account, and not on principal or most advantageous market. If these are the cases, then there will be a difference between the fair value and the transacted cost. There will be a difference. If there is a difference, we are going to record it in the P&L. We are going to record it in the P&L. It cannot be attributed if it cannot be attributed to transaction cost. If it is attributed to transaction cost, give it to transaction cost. If not, you will have to take it apart. Are you clear with this? Yes. Yes. So 4 cases, exit price not equal to entry price. Remaining all cases, exit price at fair value equals the entry price at fair value. Are we clear with this? Yes. Are we clear? Please give example for fourth case. When you have not sold it on the principal or most advantageous market, you just came and you sold the goods to the entity. You sold the inventory, you sold the items, everything to the entity. Okay. You just made a sale. You did not go to the marketplace and made the sale there. You sold it among yourselves privately outside the market. That is what is the meaning of that is the examples I could recollect on what you say transaction not happening on principal or most advantageous market. Okay, clear? Yes. So I suppose that is done. Okay, this one, have you guys done Ind AS 41? Have you guys done Ind AS 41? Ind AS 41 on agriculture, have you guys done that? No. So once you do Ind AS 41, you can revisit this. Okay. After Ind AS 41. Please revisit this after you do Ind AS 41. Problems I did. These are the disclosures. Just go through that. It is for your reference. And with that, we come to the close of the standard. I presume nothing is left. I explained this to you. Yes. I have given you examples and questions to go through. Please do visit those questions. Yes. And yeah, so nothing is pending from my side. The standard is completed. Nothing is pending. Everything is done. So just that one question, RTP question, which is mentioned, do it after you do Ind AS 41 because it is related to biological assets. You will be able to do it once you are having knowledge of Ind AS 41. Okay. So with that, we conclude our session. Anybody has any doubts, any requests, any suggestions, anything from my side that you require, any improvements from my side? Okay. Ind AS 115, you have asked for a problem solving session. I will discuss and keep it. Yes, it's required. But apart from that, anything else on your mind, please let me know. And if there is any shortcomings in the teaching, you let me know that also. That also we can address. Typically, I generally leave a little early on the weekdays because of working reasons. I leave by 9:40, 9:45. But on weekends, I try to make it up. Okay. So if there is any further suggestions that you are having, please do let me know. Any request or anything. Yes. Where are you guys from? Most of you look to be, Yadu looks to be from Andhra. Yes. And Geeta Patel, I think you are from Mumbai or the Western Zone. Shruti looks to be from maybe North Delhi side. Yes. Good. We are. So all of you are having May 24 attempts, huh? Yes, everybody is answering May 24 exam. Okay, Mohammed is from Hyderabad, Manoj is from Delhi, Geeta is from Ahmedabad. Oh, you have the final tomorrow. Okay, all right. Good. You are in the city that is the most in demand today. Yes. So tomorrow we complete your session on 108 and then we can all watch the match. Okay. All right. Oh, Rajamandri. All right. I'm fine. Fine. Good. 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 Okay. Okay. So that's nice, guys. Good to have people from such diverse locations. Good, all of you are preparing for May 24. Thank you so much for making it a very interactive session. Yes, it tends to be a little sad if nobody interacts, but you have been very much supportive in that sense. Yes, it has been great. Tomorrow we'll meet again for a very small standard, that is operating segment. Not very important, but it has come a couple of times in the examination. So it's better that we complete that. Tomorrow, a very small standard should get over by 10:30. And then we meet each other in, okay, we meet next in the December month. Okay, thanks everybody. Stay safe, revise and come. And the questions which I gave, please do those questions. Please do those questions. Don't sit over the standard once I finish explaining or once any faculty finishes explaining. Since we are divided by distance, you can make the most of this by doing it the same day and then getting the concept clear. Okay. For any doubts, feel free to reach out. And for any suggestions that you have, feel free to tell us. Okay. Thank you, everybody, and take care. Take care. Yeah. Thanks. Third session done.